know this is a company. So the word limited company, basically that implies that UNISERV is a company. So then you're being told that a supplier of office equipment, a supplier of what you call office equipment for the year ended 31st December 2023. So being given, we have what you call the trading profit before tax. We have what you call the trading profit before tax. We have what you call the trading profit before tax. The figure is 76 million. So how do you treat trading profit before tax? How do you treat it? Is it a taxable income or not a taxable income? Trading income before tax. Is that a taxable income or a non-taxable income? A trading income before tax. Is that a taxable income or a non-taxable income? Good things happen to those who are willing to move. Don't get tired. So that should be somebody to share the question, but I shared that in the group. Let Douglas get the question. Somebody to share kindly in the group. Let me check. Let me screenshot it. Normally we should be screenshotting this. If possible, we should be screenshotting this. Somebody to screenshot that. Somebody share that. Just screenshot. Now somebody screenshot. Instead of sending the whole paper, somebody just to screenshot because it's in the group. The past paper is in the group. Has somebody done that? Jaffa, can you screenshot that so that you just send in that question? Kindly do that so that we don't take time. You're now okay. So then we are being told that trading profit before tax, we'll say that that is the taxable income. The next is we get the net loss. Stop in our last class. Why did you stop? On additional information. So we begin from the additional information. We begin from what we call the additional information. So being told that legal and professional fee comprise of the following. So being told that legal fee on defense against an alleged breach of trade contract. What did you say about that? Legal fee on defense against an alleged breach of trade contract. What did you say on that? That should be allowable expense. So we do not adjust that. That is an allowable expense. You give me a yes if you're together. The next is what we call legal fee and tax appeal. So legal fee and tax appeal, those should be non-allowable expenses. Together, team, I want us to respond if we are together. If we are together, then we respond. Then we have land conveyancing. We say that land conveyancing, that is a non-allowable expense. Then the next we have what we call the stamp duty. Stamp duty is also non-allowable expense. Then we had what we call negotiating. We had what we call negotiating a business loan. So if you have a legal cost that you basically incur to negotiate a business loan, in taxation, that is basically a non-allowable expense. Together, team. Then you have what we call signing 100 years lease agreement. What did you say about signing 100 years lease agreement? What did you basically say about signing 100 years lease agreement? That should be non-allowable. That lease is above 99. Then you have the next, what you call purchase of a partner's private vehicle. Purchase of a partner's private vehicle. That is non-allowable because that is a private expenditure. Then the last one is what we call legal fee on renewal of a patent. So the legal costs that we incur to renew a patent, how do we treat them? Legal costs that we basically incur to renew a patent, that should also be non-allowable expense. So we proceed to additional information number 2. We proceed to the information number 2. So information number 2, the first one is purchase of furniture. The figure is 3 to 60. So if you have repairs and expenses, there's what we call purchase of furniture. How do you treat purchase of furniture? That is a capital expenditure. How would you treat it? Purchase of furniture. How will you treat it? That should be non-allowable expense. Then you have the next, what we call designing and partitioning. Designing and partitioning of a new office block. So when you have designing and partitioning of a new office block, how do we treat it? Designing and partitioning of a new office block, how do we treat it? Designing and partitioning, not allowable, non-allowable. Partitioning and designing, those are non-allowable. So basically claim investment allowance at the rate of 10%. On that item, we claim investment allowance at the rate of 10%. Then lastly, on that additional information number 2, repainting of old office block. Repainting of the old office block. Is that allowable or non-allowable expense? Repainting of what we call the whole office block. When you repaint an old office block, how do you treat that in taxation? Repainting of an old office block, that should be allowable expense. So we are done with that. So then you proceed to additional information number. Then you proceed to additional information number 3. So additional information number 3 is basically on general expenses. So out of general expenses, we are being told the first item is impairment of what we call patent rights. How do we treat impairment of what we call patent rights? How do we treat what we call impairment of what we call the patent right? So impairment of the patent right, that should be non-allowable expense. Then the next one, we have what we call provision for general bad debts. Provisions for general bad debts. We say in taxation, all provisions basically, all provisions in taxation, we call them non-allowable expense. So all the provisions, those should be, unless it is specific. Perfect. Then on the last item, we have what we call drawing of goods by the partners. How do we treat the drawing of goods by the partner? Drawing of goods by the partner. How do we treat what we call drawing of goods by the partner. How do we basically treat drawing of goods by the partner? So that should be non-allowable expense, non-allowable expense. So then we proceed to the next. That's additional information number 4. Purchases and sales were inclusive of VAT. So basically being told that purchases and sales, so we can have it as a working, we call it, this is on purchases. We have it purchases and what we call sales. So if you start with the sales, if you look at the sales, what is the figure for the sales? If you look at the sales, what is the figure for the sales? What is the figure for the sales? What is the figure for the sales? So the figure for the sales is a figure of 5780. 5780. So this figure, if it was inclusive of VAT, it basically implies that this figure is 116% altogether. That figure is essentially 116% if it was inclusive of VAT. Is that noted? What does VAT on sales basically do to the sales? So what does VAT on sales basically do to the sales? It basically overstates the sales. So we need to get that VAT, and what is going to be the correction? VAT on sales. So we say that if VAT was basically on these sales, it basically overstates the taxable income. So basically the correction after getting that VAT, we need to less that VAT. So then we get the 16%, which is VAT. So the VAT on that side should be, VAT should be 16 over 116. Then we have 5780. So what is the figure for the VAT? So the correction basically is that we're going to deduct by having the VAT of the sale, we basically overstated the taxable income, which is the sales. So we get the VAT on purchases. We get the VAT on purchases. So what is the figure for the purchases? So the figure for the purchases in this particular question, we have purchases to be at 706. And so this figure is inclusive of VAT. We understand that this figure is 116%. So in order to get the VAT, we understand that the VAT is 16%. So we say 16 over 116 times 3706. So what is that VAT? What is that VAT on the purchases? Give me the VAT on the purchases. Give me the VAT basically on the purchases. Give me the figure for the VAT. So that is 511,172. So what did this VAT basically do to the income statement? Having a VAT on purchases, what does it? What is the implication on the income statement? It basically means that the profit was basically understated. It basically implies that the profit was understated. So how do we correct it? How do we basically correct it? How do we correct it? We add back. We add back. Just a minute so that I attend to something 1 minute. I attend to something 1 minute. So then we basically add it back. Has this been understood by the learners? Are these points understood? Are they understood? Is it understood? If that is understood, we respond with yes. So then we proceed to the additional information number 5. So being told that closing stock, the closing stock, that is additional information number 5. The examiner tells us that the closing stock The examiner tells us that the closing stock valued. So we understand we have the first working unit, just call it closing stock. So basically the closing stock was valued at a figure of 1.2. This was the closing stock. So the closing stock was basically valued at a figure of 1.2, while the opening stock was 10% of the net sales. So the next working we look at, we call it opening stock. Opening stock together. So that is the opening stock. So the examiners tells us that the opening stock was basically valued, that the opening stock was basically valued at 10%, of was valued at 10% of sales net of value added sales. At sales net of value added sales altogether. So we can get the opening stock. So we get net sales. We get the net sales, and that is say less of VAT. So net sales less of VAT, that should be 100%, 100%. So we understand that 5780, I hope you're getting me, 5,780 is basically 16%. But sales net of value added tax, we understand is 100%. Are we together, team? Sales less of the value added tax should be 100%. Or we can just have this figure and we less from this. We'll still get the same thing. Perfect. Jaffa. So then I come here, I'll say 100 over 116, then I have times 5780,000. So what is sales less VAT? Sales less of VAT. Less VAT. What is the figure of sales less of VAT? Give me that figure of the sales less of VAT. Give me that figure of sales less of VAT. Provide that figure for me very fast. Provide that figure for me. So we have a figure of 4,792,000. 4,792,000. The other figure should be 759. 759. So I'm looking for an opening stock. The examiner tells me clearly that the opening stock is basically 10% of what? Of the net sales. So I can get an opening stock. I'll say 10% times 49, 4792, 4792, 759. So what is the opening stock? Give me the figure for the opening stock. Provide me the figure for the opening stock. So provide me the figure of opening stock, 10%. So together, perfect. So the figure should be 10%. Was this the figure? 10% of this. What is 10% if this is the figure? Somebody has given me a figure, but I doubt the figure. Unless you're giving me the wrong figure. Is this the figure of sales? Can you confirm that the figure that you're giving me is the sales figure? Can you confirm that the figure that you're basically giving me is the figure for the sales? Kindly, can we confirm, or Mwalimu to resort to doing it by himself? So this figure was wrong. A person who gave me this figure gave me a wrong figure. So the figure should be 4,982,757 together. That was the right figure. The person who gave me that figure was wrong. Yes, the person who gave me that figure. So the person who gave either, this figure was wrong. So the figure should be 49,757. 49,82,757. Are we in agreement that the figure was wrong? Which figure was right? Yes. Is this the right figure? I want you people to be alert, kindly. I want all of you to be alert. Yes, that should have been the right thing. That should have been the right figure. That should have been the right figure. So the closing stock is 10%. That should be 498,275.7. So that is essentially 498,276. So this is the opening stock. Opening stock. So that is the opening stock. Opening stock is the figure. So then we proceed to the next on the same statement. So basically, you're being told that both closing stock and opening stock were undervalued by 10%, undervalued by 10%. Both the opening stock and the closing stock were undervalued by 10%. If I start with the closing stock, if it was undervalued by 10%, it basically implies that this figure is 90%. This figure is 90%. Together, if that figure was undervalued by 10%, it essentially means that this figure is a figure of 90%. Are we in agreement? That figure is 90%. So we get the undervalue. The undervalue is 10%. Undervalue. Undervalue. We get undervalue. So the undervalue should be 10 over 90 times 1.2. So get for me closing stock undervalue. We can adjust the camera. What is the figure for the closing stock? Undervalue. What is the figure for the closing stock? Undervalue. What is the figure for the closing stock? Undervalue. So that should be a figure of 133.33. I hope the figure is right. So then we look at this again. We are being told that both closing stock and opening stock were undervalued. So this figure of opening stock, 498,276, is essentially 90%, 90% together. So this figure is undervalued by 10%, so this figure is 90%. So what is the figure for the undervalued? The 10%, which is undervalued. What is the figure? The 10% should be 10 over 90 times 498,276. What is the opening stock undervalue? What is the figure? That should be 55,364. I want us to play with something very fast. I want us to play with something here very fast. I want to come up with a small test here. I have an SP. Look at SP. I hope you're able to see. I have SP. That is the closing stock. Is 2,000. I have an opening stock. Opening stock. Let's give that opening stock to be a figure of 400. Let's have the purchases. Purchases to be a figure of 1,000. Then let's have the closing stock. Let's have the closing stock to be a figure of 500. I want us to play with this, and then we come up with what we really need to come up. Is that, are you able to see that? Are you able to see that? Are we able to see that? We respond to the yes if you're able to see that. Are we able to see that? Perfect. So I want us to get the gross profit. I want us to get the GP. So if you want to get the GP, I have shillings here. So I'll start with the SP. SP is 2,000. Then I'll get the cost of sales. I'll get the cost of sales. So for the cost of sales, I start with opening stock. Opening stock is a figure of 400. 400. Then I go to purchases. Purchases is 1,000. Then we say less the closing stock. Less the closing stock, which is 500. So what is the cost of sales? What is the closing? What is the cost of sales? What is the cost of sales? Very fast. So the cost of sales is 900. Implying if that is 900, I have my GP to be, my GP should be 1100. Together, my GP is 1100. So two scenarios. I want to open some table. Can I have this part? I hope this you copied and you give me the figure. Have you copied this? This is already copied. I want us to have something here. So I want us to have stock. And this table you have it. Effect. Then I want us to have what's called correction together. So the first scenario, I want us to play with this together. What if the closing stock is understated by 100? Meaning, what will happen to the GP? What if the opening stock is understated? What if the opening stock is understated? Instead of 400, it's understated by 100, it's 300. What is the implication? What is the implication? What is the implication? GP increases. So we have opening stock when you have the first understated. So when the opening stock is understated, what is the effect? We have GP increasing. So if GP is increasing, how should we correct the understatement? If GP is increasing, how should we correct that? We correct by deducting. We deduct stock reduce that. Team, tuko pamoja. The correction is basically, if GP is increasing, then we need to do what? We need to correct the understatement of the opening stock. Give me a yes if you're together. Kindly provide me the yes if you're together. Provide me the yes if we are together. Perfect. So the second scenario, let's play with this. What if opening stock is overstated 500? What will happen to the GP? If it is overstated. So if it's overstated, what happens to the GP? If the opening stock is overstated, what happens to the GP? GP, we understand the GP decreases. So what is the correction? The correction in this scenario is to add back. Add back. Together. If that is understood, GP decreases, so therefore we add back. So it means that this opening stock that was understated, how are we going to correct it? We are going to correct it by deducting it. By deducting. So that is a correction that you're going to apply to that. That is a correction that you're going to apply to that. That is a correction that basically we're going to apply to that. Then I have the closing stock here. I have the closing stock. So we have the first scenario, understated. A scenario where the closing stock is understated. So instead of 500, let's give this closing stock at 400. What happens when the closing stock is understated? Instead of 500, let's give it as 400. What happens to the closing stock? What happens to the closing stock? So when the closing stock is understated, we understate it with 100. What happens to the GP? What happens to the GP? What happens to the GP? GP decrease. So we understand that the GP decreases. So if the GP decreases, what should be the correction? We add back. This should be added back. In the second scenario, let's overstate. Let's say 600. So what will happen to GP? If we overstate, what happens to the GP? So the GP basically increases. The GP increases. So the correction in that case is to deduct. The correction is basically to deduct stock reduce. So in our scenario, where the GP is understated, what are we going to do? This 133.3, what are we going to do? What are we going to do in our case as per this question? What are we going to do? We are going to add back. We are going to add back. The closing stock understated, we are going to add back. So that is done. Everybody with a yes if we are together. So we can wrap this. So then, the examiner tells us, so note this in your book, kindly put it somewhere so that you know. So the examiner tells us that interest expense, the examiner tells us that the interest expense include interest on partners, include what we call interest on partners capital of 120. So interest on partners capital, how do you treat interest on partners capital? That is on partnership. So interest on partners capital, how do you basically treat it? Interest on what you call on partners capital, how do we treat it? Interest on partners capital. If it was included, we add it back. That's non-allowable expense, we add it back. So but the examiner tells us which was shared. Which was shared? We say which was shared according to the profit and loss ratio. The partners agreed that they would not receive salary until the business starts making profit. So this interest on partners capital, we just provided what they call the interest on what they call on partners capital. Interest on what they call partners capital. And the partners that we have this partner called Worker, and then we have second partner called Baraka. So they were sharing this interest on capital, basically on the profit and sharing ratio. So we know that Worker gets 5/8 times 120. Baraka gets 3/8 times 120. And these ones we're going to take to what? Income distribution schedule. Give me that. So what is the share for Worker? What is the share for the Worker? What is the share for Worker? The share for Worker? What is the share for Worker? So Worker is 75. Worker is 75. Baraka is how much? That should be 45 if it's 120. Together. So can you start the question? So the question is, the examiner asked, compute the adjusted taxable profit of partnership for the year ended the 1st December 2023 and allocation or allocation of profit or loss in the above. Are we done? Are we sorted on the analysis of that information? Is that information analyzed perfectly well? So that we start on the adjusted taxable profit. Is that information analyzed thoroughly? Perfect. So they were trading as the Worker, we just Worker and Baraka partnership. So just call it Worker. We'll just wrap everything and now we tackle the question. Which method are we going to apply to get the adjusted taxable income? Which method are we going to apply to get the adjusted net profit? Why? Because we've been provided the accounting profit. We use the net profit method. So we call it Worker. We call it Worker, and what we call and Baraka partnership. So adjusted, call it adjusted taxable. We'll call it adjusted taxable profit or loss. We'll call it for 2023. So we have those items. So starting the first one, we get the net loss. Net loss, we call it the net loss provided. What is the net loss provided? The figure for the net loss provided. What is the figure for the net loss provided? So the figure for the net loss provided, that was a negative, that's 275, 2,750,000. So that is the net loss provided. And then the examiner said, then we adjust by saying add back. And if you've been very keen on my classes, I'm saying in an exam, don't write whatever I'm going to write it together. What are we adding back? We are adding back what we call non-allowable expenses, what we call the non-allowable expenses in P&L, and what we call taxable income. We call it not in P&L. That is what we adjust here. And what did I say? In an exam, don't write this together. When you get to exam, you know that what are we adding back? We're adding back non-allowable expenses that are in the P&L and taxable income not in the P&L. In this case, you don't try to just say add back. That is in an exam. You can just say add back disallow. Just write disallow, but don't write the whole thing. So we start straight away to the expenses. So on the expenses with purchases, no, we start with purchase of computer. The first one is what we call purchase. We have it as purchase of what we call computer. What is the figure for the purchase of computer? The figure is 216. The figure is 216. Purchase of computer. The next on that P&L. The next on that P&L, we had what we call computer softwares and program. We call it computer softwares and what we call programs. So computer softwares and programs, in this case, is a figure of 1.2. Computer softwares and program is a figure of 1.2. Together, team. Is there anything on the P&L that I've not added? We check perfectly well. Is there any non-allowable expense in the P&L that has not been added? I think we're very clear. So we go to additional information. We say that legal fee on defense against alleged, that's allowable. But then we have legal fee. We say on tax appeal. Legal fee on what we call tax appeal. So legal fee on tax appeal. So the legal fee on tax appeal, that should be 64,800. Together, team, are we following? We just responded a yes. So add that back. Then conveyancing. We say of land, again, non-allowable. That should be 72,400. Perfect if it's there. And the next non-allowable is what we call the stamp duty. Stamp duty. We have the stamp duty. So the stamp duty is a figure. The stamp duty is a figure of 36,600. That is for the stamp duty. We'll move to the next. We have what we call negotiating a business loan. Negotiating what we call a business loan. So negotiating what we call a business loan. So negotiating a business loan, that's also non-allowable, 25,400, and it was included. Remember, it's part of legal fee. Then we have recovery of bad debts allowable. Signing, we have signing. 100 years. Lease, non-allowable. The lease is above 99. That should be 128,400. Signing 100 years lease, 8,400. Then you have on that, purchase of partners private vehicle. Purchase of what they call partners private. private vehicle. So the purchase of partner's private vehicle, that's non-allowable because that is a private expense. Why is it non-allowable? Because this is a private expense, and we did say that. Then we have renewal, renewal of what we call of patent. What we call the renewal of patent, the figure is 126. The figure is 126. So we proceed to this other end. So we have this renewal of patents. Renewal of patents. So then we get to the next additional information. So that is on repairs. So being told that on repairs, there was purchase of furniture, that's a capital expenditure. So we have purchase, we have what we call purchase of furniture. What is the figure for the purchase of furniture? That should be 260. 260. Purchase of furniture. That should be 260. We also have designing and partitioning. Designing and what we call partitioning. So designing and partitioning, that should be 341,000. So we add it back, that should be 341. That's a capital expenditure. So repainting, that was okay. So then we move to the next, what we call impairment of patent right. So we have an allowable impairment. We say of patent, impairment of the patent. So what do you have as the impairment of the patent? That should be 120. We have impairment of the patent. That should be 120. Then you have provision. Provision, we say for general budget. For general budget, provision for what we call general budget. That should be 208,000. Provision for general budget, that should be 208,000. All provisions in taxation are non-allowable, so we add it back. Then we have drawing by partners. We have what we call drawing by partners. So drawing by partners, we also say is non-allowable, so that should be 314 together. But you say there's some items that we need to. What are we adding back? VAT on purchases. We add back VAT on purchases altogether because that understated. So what is the VAT on purchases? Give me the figure for the VAT on purchases. VAT on purchases, what was the figure? That understated the profit, that's why we had it back. What was the figure for the VAT on purchases? Give me that VAT on purchases. So that was 511. We have it as 511, 172. 511, 172. But you also say that closing stock understated. Closing stock understated. How do we correct it? We adjust it by adding it back. So we have closing stock. Closing stock. We have it understated. Understated. So what is the closing stock understated? That is 133.33. Add it back together. Is the figure correct? The closing stock understated? Is the figure correct? Perfect. But you also had one, if you look at the last additional information, that interest on that interest expense include what we call partners' interest on partners' capital. So we also had back interest, we say on partners' capital. So what is the figure for the interest on partners' capital? What is the figure for the interest on partners' capital? That should be 120. Together. All of us, are we together on those interests? If you're together, we respond with a yes. Are we following? Alan, are we together? Alan, are we together? Brian, are we together? Alan, Brian, Ida, Jaffa, Awiko, Matsura, Zipporah, are we together? Perfect. So then you say we less. In an exam, I just say you put less, you don't do the whole thing. In an exam, just put less. So say, what are we lessing? We call it non-taxable income in P&L. And we have the investment income in P&L, investment income in P&L. Then we have what we call allowable expenses. We call it not in P&L. Allowable expenses not in P&L. So we go to the incomes up there. We go to the incomes up there. So we start with those income. What did you say about general budget recovery? Are those taxable income or non-taxable income? General budget recovery, did you say they are taxable or non-taxable? General budget recovery, for those who are noting, so we left them. So start with general budgets recovery. So general budget recovery, we have a figure of 75. So this one you get me the total. You'll get me the total. You just sort it fast. General budget recovery. What about anticipated? What do you say about anticipated foreign exchange gain? Anticipated foreign exchange gain. That's non-allowable, so we call it anticipated. We call it foreign exchange gain. Exchange gain. So that's non-taxable. So non-taxable. So you have the figure already. Thank you. So that is 4,014,505. Thank you. So anticipated, what we call the anticipated, that's unrealized. So that's non-taxable. So the figure is 180. The figure is 180. The figure is 180. Then you have capital gain. That's also non-taxable. Capital gain. We call it gain on sale of what we call land. Capital gain on the sale of land. So capital gain on the sale of land. Capital gain on the sale of land. That was 352. So that's also non-taxable. Capital gain on the sale of land, that should be 352. What did you say insurance recovery on stolen vehicle? What did you say on insurance recovery on stolen vehicle? That's non-taxable. So we have insurance recovery on stolen vehicle. Stolen vehicle. What is the figure? The figure is 320. Together, all of us, let me adjust the camera. So together, insurance recovery on stolen vehicle. Insurance recovery on the stolen vehicle. All of us together. Perfect. So then we get to the next, what did you say? Release of liability. What did you say on the release of liability? That was taxable, unless there's something specific. It's liability on maybe fixed asset. But when they just say release on liability, then that we essentially treat as a taxable income, So we don't adjust it together. We respond to the yes, so we do not adjust. Kindly respond to the yes. So then we have the next is VAT on sales. We have the VAT on sales. What is the VAT on sales? VAT on sales. The figure for the VAT on sales. VAT on sales. So what is the VAT on sales? What is the VAT on sales? Kindly provide for me the figure 791. We have it as 241. Somebody to confirm what Douglas is giving. 797 Douglas. I think it should be 797. 241. 1. So then because we want to distribute this entry, we can just proceed from here because we want those entries. Are you able to see that? Are you able to see that? Because we need those entries just to adjust. We need those, a little bit of those entry. We need those entries together. So then we proceed now. Opening stock understated. Opening stock understated. So what is the opening stock understated? What is the figure? The opening stock understated. What is the big figure? What is the big figure for the opening stock understated? So opening stock understated. So that was 55. Well, less correction was basically less it. 55,364. Then we move to the next now, investment allowance. Investment allowance. This is the next topic that we are in, so bear with me. I said investment allowance, you bear with me. This will be the next topic that we're going to handle. Is that okay, team? When you get to investment allowance, you're going to understand it even much better. Are we together? Investment allowance, I've said you bear with Mwalimu, because that will be the next. After finishing all this, then we get to the investment allowance, kindly. So then within capital, we grant, instead of depreciation in taxation, we grant what we call investment allowance. That is on fixed asset. So the first investment allowance was computers. Computer is a fixed asset. We need to grant investment allowance. We said that for computer and computer attachment, the rate is 25%. 25%. So we have computer. We have the computer. So computer should be 25% times the figure of the computer. That should be 216. So what is 25% of 216? So computer is investment allowance under the rate of 25%. 25%. So what is 25% of 216 for the computer? 25% of 216, that should be 54. That should be 54. That should be 54. Then the next fixed asset that we have, computer softwares and program. We call it softwares. So computer software again falls under 25%. So 25% times, we have it as 1.2 million. What is 25% of 1.2 million? 25% of 1.2 million. 25% of, that is 300,000. 300,000. So the next fixed asset, we get it under repairs. So under repairs, we have furnitures. Furniture is 10%. So 10% of the amount of furniture that is 260. So what is 10% of 260? That should be 26. 26. That should be 26. 10% of 260. That should basically be 26. Is that okay? 10%. That should be 26. Then we have partitioning. Partitioning is also 10%. Design and partitioning, that is 10% times 341 times 341. So 10% of 341, that should be 34,100. Together, that should be 34,100. We respond with a yes if you're together. That should basically be 34,100. 34,100. Together, team. We respond with a yes if we are together. We respond with a yes if we are together. So if you're together, is there any expense that we've not included? Is there any that we've not included? Capital expenditure for investment allowance. Is there any that we have not included? There's none. So I want to show you where I get those figures of 25% and 10%. Look at this table. Before you even get there, look at this table. The first table on taxation paper. Are you seeing that table? Are we seeing those table? Where I'm getting those figures, 25, 10%, and 10%. Are we there? The table on the first page, we respond with a yes. We respond with a yes if we are able to see that table. So get to the second under machinery. Are you on machinery? Get to the second under machinery. So look at the first one. We were talking about computer softwares, calculator, copy and duplicating machine. Are you seeing 25%? Computer softwares, calculators, copiers, duplicating machine. What is the rate? Somebody is asking, where did Mwalimu get? That is 25%. Are you seeing 25%? Why I'm using 25% for the computer and computer software. B, I want you to look at B on that table. That is all bordered. On that table, that is all bordered. Are you seeing computer software under machinery? The rate is 25%. Are you seeing that? If you're able to see that, you respond with a yes. Perfect if you're able to see that. Then again, look at furniture down there. Why am I using 10%? Because somebody is asking, why am I using 10% though we've not got it there? We say furniture and fitting is 10% on a straight line. Are you seeing that? 10% on a straight line. 10% on a straight line. Are you seeing that? 10% on a straight line. Then down there we're told that other machinery. So partition falls under other machinery. That should be, partitioning should be, it falls under other machinery. Are you seeing 10%? Are you seeing 10%? We respond with a yes if we can see. There's only one person who see that. All of us, can you say that you can see that? All of us, can we respond? Alan, are we able to see those things that I was showing? Perfect. So how much are we lessing? How much are we lessing? So 75, 180, 352, 320, 797 to 41. Perfect, Alan. So how much are we lessing? How much are we lessing? So we start from this. How much are we lessing? How much are we basically lessing? So add this and then add this. How much are we lessing in total? How much are we lessing in total? How much are we lessing in total? So that's correct. Somebody says 21, 21.93. Somebody says 21.93, 703, 705. Somebody to confirm that. Let Mwalimu assist. So are we getting the same thing? I'm getting the same thing, 2197, 2197, 2197, 2193, 705. Are we having the same? Are we having the same? Douglas, 2193, 705. Are we having the same? Douglas, you are missing something. Are we having that? Perfect. So then we adjust that. What is adjusted taxable profit or loss? Adjusted. What do you call that? Adjusted? Adjusted taxable. Taxable profit or loss. The adjusted taxable profit or loss. So we have a loss of 2,750,000. You had to 4 million. You had to 4 million, 14,505. Then you less 2 million. Then you less 2,193,705. What is adjusted taxable profit? What is adjusted? So say we have a loss already, a loss of 2 million, a loss of 2 million, 2,750,000. Then you had 4,014,505. Then you have 21,93,705. So what do you have as the loss? So the loss is 929,200. That is the loss. The loss is 929,200. Are we having that loss? The loss is saying is 929,200. The loss is 929,200. So then how do we distribute this? There's no mark for this. Kindly, there's no mark for that. But the marks are this 1, 2, 3, 4, 5, 6, 7, 8, 9. We have 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 21, 2, 3, 4, 5, 6, 7. So we have 27 entries. 27 entries. So any 24 times a half. That should give you 12. So in that particular question, we have 27 entries, but you only need any 24, then you have the whole mark together. You only need only 24, then you had the whole marks. So we have the whole mark. Any 24 will give you the whole mark. Yes, if you're not able to compute, those are only two, this entry and this entry. You'll have everything. You'll still have everything. If I'm able to compute closing stock and that, yes, you still have everything. Because we don't mark answers, we mark entries. Douglas, you should be able to still have everything. If other things are instant, you have everything. Yes, you will still have everything. Yes, you will still have everything. I think because most people don't know, that's why most people fail. But if you know what goes on, nobody should fail in my class. Yes. So that's okay. So I want us to do the next part. Then we close on partnership. After doing this, then we shall be done with partnership. Is that all correct? Once I do the second, once I finish this, then we shall be done with partnership. Is that true? Once this is done, then I should be done with partnership. Perfect. So the second part is income distribution schedule. That is the income distribution schedule. Then we come and start on limited company. Income distribution schedule. So we have the next, that is what we call the income So then the other which we get to the next, that is the income distribution schedule. So the second, allocation of profit and loss. So that is what we call the income distribution. We call it the income distribution schedule. We call it the income distribution schedule. So we don't tax partnership, but we tax individuals that are in partnership. So we had Waka, we have Baraka, and then we have Total. We had Baraka, Waka, and then Total. Waka, Baraka, then we have what we call the Total. Are we there, team? If you're there, we respond with yes. If we are there, then we respond with a yes. So what do we have on this? We only have the first thing is interest. interest, we call it on capital, interest on capital. So interest on capital was 120. Interest on capital was 120. What we call interest on capital was 120. So interest, how are we supposed to share the interest on capital? Interest on capital, Baraka was supposed to get, we had apportioned it. Baraka was supposed to get, how much was Baraka? 75. So Baraka, sorry, Waka, we started, Waka was supposed to, Waka is 75, yes, Waka is 75, Baraka was 45. When you look at that, Waka gets 5/8, which is equivalent to 75. Baraka gets 3/8, which is equivalent to 45. So that is 120. In this question, do we have salaries to partners? Do we have salaries to partners in this particular question? Partners agreed not to get salary until they make profit altogether. Do we have interest on drawing? Do we have interest on drawing? We don't have interest on drawing. Are we together? So we have the profit share. There's not even commission to partners. Profit stroke loss share. So what we call the loss share. Profit stroke what we call the loss share. Remember that is done on ratio. Hold it there. Hold it there. So then we have the net adjusted taxable. We have now the adjusted taxable loss altogether. Adjusted taxable loss. What are the adjusted taxable loss? That was 920. 920. Give me that. The figure was 920. The loss was 9. What was the loss? So we have it 9. So this is B, and this should be A. This is B, and that should be A. So the profit or loss share is C. C should be B minus A. So what is the C? What is the C? What is that C? What is the C? So negative minus a positive. What is the figure? So we have it as 1,200,000. So share that. Share that. So that loss, we know that Waka gets 5/8 times 1049,200. We get this gets 3/8 times 1049,200 times 1049,200. So get with that. So then you have a 655. $750, which is a loss. This should be. The other one should be. The other one should be. 393,400. So get for me this. What is adjusted? What goes for? So get for me that. What goes to Waka when you less that? So add this to this. What do you have? $730. Add. It cannot. This is not a negative. This is a positive. That's a positive. So 580. What about this? $348, $450. All of us, are we together? All of us, are we together? All of us, are we together? Perfect. So what is the marking point? 1, 2, 3, 4. So any 2 times 1. So any 2 will give you, in most cases, students will not get this, but if you show this and this, you have everything. If you show that, you have everything. These are losses, sorry. These are losses, so we don't even tax this. So any 2, I'm just saying any 2, this in most cases, students will not get. Are we together? So is that okay? Is that okay? Is that okay? Perfect. So if you get, even if you show this interest, that was the whole mark. You just show this, that gives you everything. So we can have our break. Or can we continue? We can have our break and come for, we'll start on limited company. Taxation of the limited company. Together, we start on the taxation of a limited company. So partnership is done. Taxation of partnership is done. So you come back and start on limited company. So interest from 𝐿𝐍 Limited was supposed to be added. If we had a figure of, what was the figure? So 9, we had a loss of 929,200. You're supposed to add another 30. That was 34. The figure was 34. The figure should have been 34. That should have been 34. So what was the total loss? Add that. When you add that, this was a loss and a loss. What should have been that? Correct that. What should have been that? That was another entry. Sorry, those should have been 28 entries. So what should have that been? Very fast. Kindly then you start on what should have been the loss. If you add that, team, if you add that, you skip that, you did not give me that. Galma, that should have, no. You add them together. Negative. Look up negative and negative. So that should be 960. Those should be the same, negative 963,200. So this should be, so this is the correct adjusted. We call it adjusted taxable loss. Sawa. That is the correct adjusted taxable loss. So you change that. Then when it comes to this, that should be 963,200. Kindly be keen. Douglas, there's something that you did not give Mwalimu. I think we left it. Interest from 𝐿𝐍. Douglas, are you able to see interest from 𝐿𝐍 circle? Non-taxable income that we are lessening. That figure we should have added interest from 𝐿𝐍 together. And it seems that all of you are not keen on that. So that should have been less. So the figure that we got, we should change. The adjusted taxable loss is 963,200. Together noted. That is adjusted taxable loss. When you come here, you just change this. What should be the figure? That should now be 10. 10. The adjusted figure, that should be 10. Mwalimu should now support the students. So that is 1083,200. That should have been the right figure, 1083. I will not allow you alone. I will be supporting you. So 1083, 200, 1083, 200, 1083, 200. So 5, 8 times 1083, 200. So this should be 677. And this so this should be 406, 200. So this should be 361, 200. That should be 6. So this should be 602. So that's okay. Perfect. That is sorted. So that is closed. Just correct that. Everybody okay? I want to start taxation of a limited company. Taxation of a limited company. We close that kindly. Perfect. So we go to the taxation of what we call a limited company. Taxation of a limited company. Taxation of what we call a limited company. So I want us to put a few things on this together. That is on taxation of a limited company. Taxation of a limited company. In the next 7 minutes, we should be done with this discussion and start a question. So remember, a limited company is what we call a separate legal entity, we say, from its owners altogether. So when you talk about limited company, it is a separate legal entity from the people, from its owner, from the people that formed it. So basically implying that, therefore, we say it is taxed. It is taxed on its own income. So in that case, understand that companies are basically taxed. Since companies are separate legal entities from its owners, it's therefore taxed on its own income altogether. It's therefore taxed on its own income, and that is its own taxable income. Since company is a separate legal entity from its owners. Together, team. So therefore, companies are basically taxed separately from its owners. We give a yes if we're together. So then we understand the following. We say the following is considered. The following is considered in taxation. We say in taxation of what we call a limited company. So the following is basically is considered in taxation of a limited company. So the first point is what we call determination. We call it determination of what we call of taxable income. So determination of taxable income. When it comes to determination of taxable income, we basically understand that for companies, we basically use two methods. We have the net profit method, and then we have what we call the gross profit method. So we have the net profit method, and then we have the gross profit method. So net profit method basically implies that when an accounting profit is provided, when accounting profit is basically provided, you adjust it to get the taxable profit. You adjust it to get the taxable profit. Gross profit method, we basically use it when the accounting profit is not provided. So the second item is determination. We call it determination of what we call of tax payable. So how do we determine the tax payable for limited company? The second step is basically determination of the tax payable. So basically bracket companies into two. We have what we call resident company, and then we have what we call the non-resident company. So we have what we call the resident company, and then we have what we call the non-resident company. How do we tax resident companies? We understand that for resident company, we basically tax it at corporate rate of what we call 30%. 30%. For the non-resident, we tax at what we call corporate rate of what we call 37.5%, 0.5%. But when you look at the resident company, when it was 2020, I don't know when we tax the corporate resident company in 2020. What was the rate that we were using in 2020? For 2020, we used 25 as part of COVID measures. So we taxed them at 30%, but 2020, we taxed them at 25%. Then under company, we have what's called, number 3, we call it additional. We call it additional allowable expenses, allowable expenses, we say for limited company, additional allowable expenses for the company. So under limited company, we have what we call additional allowable expenses for the limited company. So we say payments to the direct. One is what's called payments. We call it the payments. We say to the directors, payments to the directors. So under company, we say payments to partners were basically non-allowable. Are we together? However, when we have a limited company, payments that are basically made to the directors are allowable. For example, for services rendered, for services rendered, i.e., we have the director's salary, we have the director's salary, we have what's called the director's salary, we have the director's salary, remuneration, etc. So director's salaries remuneration is additional allowable expenses. Then for company, we have the second, what we call debenture interest. Debenture interest. So when companies take loan, when companies basically take loans to invest in the business, those interest on loans are basically allowable expense. Then we have, lastly, we call it the cost of issuing shares. The cost of issuing shares. We also call it flotation cost. So these are what we call additional allowable expenses for the company. Apart from what we mentioned, for the company, the specific additional, when we talk about company that we had, we say payment to the directors for the services rendered, we have the directors' salaries, we have the directors' remuneration, then we have debenture interest. The loans that are basically taken by the company to invest so that they can generate more income. Then we have the cost of issuing shares that we also call the flotation cost. Those are additional allowable expenses. When you say allowable expenses, these are expenses that we say these are expenses that can basically be deducted against a taxable income. Then I talk about additional. We talk about additional non-allowable expenses. So additional non-allowable expenses for the company. What we call additional non-allowable expenses. What are these additional and non-allowable expenses for the company? We have all reserves. When you say transfer to reserves, all reserves are basically additional non-allowable expenses. All forms of dividends. We say all forms of dividends, all forms of what we call dividends. All forms of dividends, i.e., when you have what's called the interim dividends, final dividends. Final dividends, these are additional non-allowable expense. So that is the end of that information that we needed for company. Is that information absorbed? Is that information at home? Is that information at home? Is that information at home? So I want us to pick a question if that information is at home. I want us to pick a question. I want us to pick a question if that information is at home. If that information is at home. I want us to pick that information. If that information is at home. I want us to pick December. That is December 2024. December 2024. December 2024. That is question 5. Question 5C. Question 5C. December 2024. Question 5C. December 2024. Question 5C. December. Deck 24, question 5C. Are we on it? If you're on it, we'll respond to yes. If we are on it, then we give it a yes. Perfect, Gal. So we've been told the following information has been extracted from the books of 𝐿𝐿 Limited. So the word limited basically implies that is the company. Somebody will ask me, Mwalimu, how do you know this is the company? So the word limited company basically that implies that 𝐿𝐿
consolidated financial statement. So maybe first of all, we need to ask ourselves, what are the group accounts or what are the consolidated financial statements? So these are the financial statements which are prepared by something called a parent company or by a company which is known as a parent company or a holding company by combining or basically by consolidating similar items of assets and liabilities, revenue and expenses, those of the parent and those of the subsidiaries. So from company law, I hope you can be able to remember what is a parent company or what is a holding company and basically what is a subsidiary. A holding company or basically a parent company, is a company which has acquired the majority of the shares or basically more than 50% of the shares issued by another company. So the company which has acquired the majority of the shares is known as the parent or the holding company, whereas now the other company is known as the subsidiary company. So like assuming in this case we have a company A, and you're told that this company has acquired more than 50% of the ordinary shares, basically which are issued by company B. So in this case, this company here is known as the parent company. In other terms, this can also be known as the holding company, whereas this company here is known as the subsidiary company. So now this company, which is called the parent company, at the end of each year is basically expected to prepare the group account or the consolidated financial statement. And we are saying that these group accounts are prepared by this company by combining similar items, of what? Of assets, liabilities, revenue and expenses, those of the parent company and those of who? Of the subsidiary. And in this case, it is very, very important for you to understand that these group accounts are not prepared by any other company, but purely they are prepared by the parent. So it is not the subsidiary company to prepare the group account, but the group account should be prepared by who? The parent company. So therefore, as far as this topic is concerned, we're going to look on how we prepare the group account. And also, in this case, we're going to discuss in detail some of the accounting standards, which basically governs the preparation of this particular group work. group account. But even before we proceed to do that, to look on those specific standards, to look on how we prepare the group account. First of all, I want us to maybe look on definition of various terms. So these are some of the important terms we need to understand even before you proceed to prepare the group account. The first term here is basically called, or the first term is group. And in this case, when we talk about the group, basically this refers to the parent company and its subsidiaries. The parent company and its subsidiary company. So meaning that if, for example, we have this company and this company has one subsidiary, or maybe this company has two subsidiaries, then we refer to this as a group of companies. So the parent company and its subsidiaries are known as a group of what? Of companies. So in this case, we have said whenever you have a group of companies, then you have said that this company here, that is the parent company or the holding company, is the one which has an obligation to prepare the group account or to prepare the consolidated financial statement. So the other term we can also define here is the parent, or basically the holding company. And we say that this is a company which controls, this is a company which controls another company, and the other company which is controlled, in this case, we refer to it as a subsidiary company. So this company, the parent company, controls another company which is known as the subsidiary. Basically, control it's determined in terms of checking the percentage shareholding. So if this company here has acquired majority of the shares, more than 50%, we say that this company controls the other. Though this control or basically the control does not exist, whereby a parent company has acquired majority of the shares. Generally, we say this company controls this one. Number one, if the parent company controls the composition of the board of directors. What does that mean? It means that if this company here, company A, appoint majority of the directors in company B, so then in this case, we say that this company here controls the composition of the board of directors of company B. Number two, this company will also be deemed to be controlling this one if this company here basically do what? It controls, we can just put that there, it controls the operating and the financial decisions of the subsidiary. And actually, in this case, the parent company controls the operating and financial decisions made by the subsidiary if this company here is the one which appoints the senior managers of this company. So the parent company controls the operating and financial decision of the subsidiary by doing what? By appointing the senior managers. By appointing the senior managers in the subsidiary company. So if the senior managers of the subsidiary company are appointed by the parent company, then in such a case, we say that this company controls what? Controls a company B. So therefore, it is very, very important for you to understand here that you may be told that this company here, for example, acquired like 45% of the shares issued by company B, but company A is the one which appoints majority of the directors. It also appoints the senior managers of company B. In that case, the control exists. Yes, so in this case, we continue. So what I've said is that if you're told company A maybe acquired like 45% or even 50% of the shares in B, then you're also given information that company A is the one which appoints majority of the directors in company B. Company A is the one which appoints the senior managers of company B. It basically means that company A exercises control over company B. And therefore, company A will be the parent, company B will be what? The subsidiary. So the other term we also need to define here, number 3, is the term business combination. Business combination. So what do you mean by business combination? The business combination basically we say is the event, or is basically that transaction where the parent company, acquires control in the subsidiary company. That transaction where the parent company acquires the control in the subsidiary company, we refer to that transaction as a business combination. In other terms, we say company A has actually acquired company B. That transaction itself, we refer to it as a business what? A business combination. The other term we also need to understand here, which is number 4. Number 4 is something called non-controlling interest. Non-controlling interest, or basically NCI. And NCI, this refers to the shares issued by the subsidiary company, and not held by the parent. So these are basically the shares issued, which are issued by the subsidiary company and not held by the parent company. Not held by the parent company. What does that mean? Let's assume that we are told that this company here, that is the company A, has acquired 80% of the ordinary shares issued by company B. So it means that 20% of the shares issued by company B, 20% of the shares issued by company B, which is a subsidiary, they are not held by the parent company. The parent company only holds 80% of the shares issued by company B. And therefore, these shares, these 20% of the shares issued by the subsidiary, they are not held by the parent company. We refer to that portion of the shares as the non-controlling interest. So we say that these particular shares here are held by the minority shareholders. The minority shareholders are not in a position to control the operating and financial decisions of company B. They are not in a position to control the composition of the board of directors of company B. That's why we say their stake, their interest in this particular company is what? Is a non-controlling interest. So these maybe are some of the terms you need to understand even before you proceed to look on how we prepare the group what? We prepare the group account. Then from there, we can proceed and look on some of the standards which are applicable in preparation of the group account. So we look on international accounting standards and also international financial reporting standards, which are applicable in the preparation of group account. So which accounting standards are applicable in the preparation of group account? So here we have basically a number of standards which are basically applicable. So let's proceed. In this case, we have various international accounting standards, international financial reporting standards, which are applicable in the preparation of group accounts. So number 1, we have international financial reporting standards number 3, and basically this deals with a business combination. Remember, in this case, we have defined a business combination as that transaction through which the parent company acquires the control over the subsidiary. We're going to look on what is the provision of this standard here as far as the business combination is concerned. The other standard which is also applicable in preparation of group accounts is IFRS 10. And basically this deals with how we prepare the consolidated financial statement, specifically whereby the parent company has made investment or has invested in a subsidiary company. How do we prepare group account? How do we prepare consolidated financial statements whereby the parent company has invested in a subsidiary? The other accounting standard which is also applicable here is the IFRS 11. IFRS 11, and basically this deals with how we prepare the group account, whereby the parent company has entered in something called a joint arrangement. We will be able to discuss this later on. And then from there, we also have international accounting standard number 28. And basically this deals with how we prepare the consolidated financial statements, whereby the parent company has invested. The parent company has made investment in an associate, or basically joint venture. So these are basically some of the accounting standards which you're going to come across as far as this topic is what is concerned. I want us we start with the first standard here, IFRS 3. IFRS 3, which basically deals with the business combination. The business combination. So remember, business combination, we have said, is the transaction through which the parent company acquires the control in the subsidiary. Now, this particular standard requires that on the date of business combination, on the date of the business combination, or basically on that particular date, when the parent company acquires the subsidiary, the parent company must determine the goodwill arising from business combination. So therefore, this particular standard here basically governs how the goodwill arising from business combination, combination. So how this particular goodwill should be computed? Should be what? Should be computed. So first of all, what do you mean by goodwill? Goodwill, basically, this is the difference between goodwill is the difference between the purchase consideration which was paid. The purchase consideration, in other terms, we refer to this as the cost of investment. The cost of investment and the fair value of net assets acquired. Fair value of net assets acquired. So the difference between the purchase consideration which was paid by the parent company in acquiring the subsidiary and the fair value of the net asset acquired, we refer to that as what? The goodwill. For example, in this case, we may be told that when the parent company was, or maybe company A, which is the parent company, acquired like 80% of the ordinary shares issued by company B, and this company paid automatically whenever a company is buying shares of another one, that company must pay for those shares. So the amount which is paid is what you refer as the purchase consideration or the cost of investment. Remember, our company is investing in acquiring a subsidiary. So that investment costed company A how much? We may be told that this company paid 100 million. Paid 100 million. That is the purchase consideration or the cost of investment. So in this case, what we do, we compare this purchase consideration which was paid with the fair value of the net assets which were acquired. Automatically, whenever this company is being acquired, that company must revalue the assets, must determine the fair value or the current market value of each asset. So like in this case, assuming we are told that on the date this company was acquired, maybe it's net assets. The net asset of this company had a fair value of maybe 200 million. 200 million. 200 million, or let's just take this to be 100 million. 100 million. So to determine the goodwill, we are saying we take the purchase consideration which was paid. How much is that? Is 100 million. We less the fair value of the net asset acquired. In this case, we take the net asset of this company, which were 100 million. 100 million. But because our parent company acquired 80% of the shares in company B, the parent company didn't acquire all the shares of company B. The parent company also acquired acquired net assets equal to 80%. So therefore, the net asset acquired will be 80% of this. Will be 80% of that. So the difference between 100 million and basically 80 million, which is 20 million, this one we say is the goodwill arising from what? Arising from business combination. The goodwill arising from the business what? Combination. So this particular goodwill basically is determined in accordance with IFRS 3. IFRS 3, basically we are saying this deals with or governs the aspect of business what? Combination. It requires that on the date of acquisition, on the date the parent company acquired the subsidiary, in this case, the parent company must determine the goodwill arising from business combination. The goodwill arising from business combination. So naturally, I've said goodwill is the difference between purchase consideration which was paid and the net asset which were acquired. Now, according to this standard here, there are two methods which can be used by the parent company to compute this goodwill. Two methods of computing the goodwill, methods of computing a goodwill. Computing goodwill. And basically, whatever we are discussing here is very, very important. Very, very important as far as this topic is concerned. You'll be able to see that even before you look on an illustration, as far as this topic is concerned, I think we will take two classes. Today's class and in our next class, here will be an introduction to this topic. So we are laying foundation. We are laying foundation on this topic because we are saying this topic is very, very important. Whatever we are discussing today and actually what we will discuss in our next class is very important. You must understand it. Otherwise, if you don't understand what you're discussing, you will then have a problem when you start doing some illustration. Whatever you're discussing here is one of the very important concepts because you'll come across this in all questions for group accounts. So how do we compute this goodwill arising from business combination? We have two methods. We have the first one, which is called the partial goodwill method. The partial goodwill method. And number two, we have the full goodwill method. We have the full goodwill method. So those are the two methods which are used in the computation of goodwill. And basically, I want us to look on how we compute the goodwill under the two methods. And we will start with the first one, which is the partial goodwill method. A partial goodwill method, partial goodwill method. Now, even before we look on how we compute this, the goodwill under this method, let me have a small illustration here, assuming we have company A, and this company we are told acquired 80% of the shares in company B. In company B, in this case, we have said 20% of the shares issued by this company, they are referred to as NCI. 20% of the shares issued by company B. Those are the shares which are not held by the parent. So under this particular method here, under this method, we compute the goodwill. We compute the goodwill of the parent company only. Under the partial goodwill method, we compute the goodwill of the parent company because it is important to note when computing this goodwill, we are saying we compare the purchase consideration paid and the net asset acquired. Basically, the net asset acquired in this subsidiary. So the net asset of this company have been acquired by the parent company, and some of them have been acquired by who? The minority shareholders, the NCI. Let me just use that word, non-controlling interest. So the shares issued by the assets of this company, 80% acquired by the parent, and basically 20% acquired by who? NCI. We are saying under this method, we only compute the goodwill of this company. It basically means that in computing that goodwill, we will compare the purchase consideration which was paid by the parent company in acquiring 80% of the shares here and the net asset the parent company acquired. So the net asset acquired by the parent will be 80% of the net asset of the subsidiary. That's that? Yes. So therefore, under this method, we compute the goodwill of the parent company only. So how do we compute that goodwill? How do we compute the goodwill arising from business combination? Goodwill on acquisition. The computation of goodwill on acquisition using the partial goodwill method. So here we take the purchase consideration, which was paid by the parent company. So how much amount was paid by the parent company in acquiring 80% of the shares in the subsidiary? And then to this we less fair value of net assets, acquired by the parent company. Fair value of the net asset acquired by the parent company. Like in this case, I've said to compute this fair value of the net asset acquired by the parent company, you take the parent company shareholding in the subsidiary, you multiply that with the subsidiary company fair value of the net asset at the date of acquisition. At the date of acquisition. At the date this company was acquired, what was the fair value of its net assets? What was the fair value of its net assets? This is something which the examiner will not have given you, but basically will be able to explain how do we compute that. So you less that. You less that. Whatever you get here will be a goodwill, on acquisition if basically you get a positive figure, but there are some instances whereby you can get a negative figure. So if you get a negative figure, it means that whatever the parent company paid in acquiring the net asset of B was less than the net asset acquired. So if you get a negative figure there, that one is called a gain, is referred to as a gain on bargain purchase. A gain on bargain purchase. In this case, we say that the parent company was able to bargain and it acquired the subsidiary at a profit, or basically at a gain. It was able to bargain, it acquired the subsidiary at a gain or at a profit. Now, this goodwill, this one is recognized as an asset, or basically as an non-current asset in the consolidated statement of financial position. So when the parent company here is preparing the consolidated balance sheet, the consolidated statement of financial position, which is basically prepared by adding some assets and liabilities of the parent and those of the subsidiary, this one will be recognized there as an asset. As what? As an asset. But this one, a gain on bargain purchase, this one is recognized as part of the other incomes, in the consolidated income statement. When the parent company is preparing the consolidated income statement, which is prepared by combining revenue and expenses of the parent and that of the subsidiary, this one is recognized there as part of the other income. So therefore, under the partial goodwill method, we compute the goodwill of the parent company only, and basically that is how we compute that. Purchase consideration which was paid by the parent minus the fair value of the net asset which was acquired by who? The parent. But in this case, it is also important for you to note here, or basically what is important to know here, is that in most of the exam questions, the examiner will not have given you some information that use the partial goodwill method, use the full. In most of the cases, if the examiner or if the group, the parent company, or the policy of the group is to compute the goodwill using the partial goodwill method, in the additional information, you will come across this statement. You'll come across a statement that it is the policy of the group. It is the policy of the group to measure NCI at their proportionate share. Their proportionate share over fair value of net assets. So once you come across this particular statement, in the additional information is upon you to know that you use the partial goodwill method. You'll come across this statement in the policy of the group to measure the NCI at the proportionate share of the fair value of the net asset. So once you were given that information, you automatically know that when computing the goodwill, the method to be applied is what? Is the partial goodwill method. The other method, let's move to method number 2, is the full goodwill method. The full goodwill method. Now, under this particular method here, that is the full goodwill method, we compute the goodwill of the parent company and the goodwill of the NCI. The goodwill of the parent, the goodwill of who? Of NCI. Remember, the net asset acquired in this or the net asset of this company are acquired by two categories of shareholders. They are acquired by the parent company, who is the majority shareholders here, and they are also acquired by the NCI, who are the minority shareholders here. So therefore, the parent company, when acquiring 80% of the assets, it pays some purchase consideration. When the minority shareholders are acquiring 20% of the net asset here, they equally pay purchase consideration. So under this method, we compute the goodwill of the parent and the goodwill of who? Of the NCI. So the goodwill which is computed here is the goodwill of the parent company and the NCI Parent company is the majority shareholder, NCI is the minority shareholder. So how do we compute that goodwill? That goodwill on acquisition. On acquisition, using what? Using this method here, using the full goodwill method. So here we start with the purchase consideration. Purchase consideration paid by parent company, paid by parent company. So how much amount was paid by the parent company in acquiring the shares? And then to this, we add something called the NCI at fair value. So what is NCI at fair value? NCI at fair value is something which the examiner will have given you in most of the questions. So the NCI at fair value, in other terms, this is the purchase consideration paid by minority shareholders, paid by NCI. So when NCI were acquiring 20% of their shares, how much amount did they pay? So we basically add those two values. We add those two values, and this now will give us the purchase consideration paid by the parent and who? NCI. Then from there we proceed, and then we left the net asset acquired by both the parent and also who? NCI. So to this we left. To this we left. To this total amount we left. We left and the fair value of net assets acquired by the parent and the NCI. We left the fair value of the net asset acquired by the parent and NCI. So I've said I'll be able to show you how we compute this one. So on the date this company was acquired, on the date the subsidiary company was acquired by both the parent and the minority shareholders, what is the fair value of each net asset? I've said that is something which the examiner will not have given you, but basically I'll show you how we compute that. So we then start from this amount. We can get a positive figure or basically a negative figure. So if it is a positive figure, I've said that is a goodwill. But if you get a negative figure, that one is called a gain on bargain purchase. A gain on bargain purchase. Again on bargain purchase, of which you have said this one is an asset in the consolidated statement of financial position. This one is an income in the consolidated statement of financial position. So in the consolidated statement of profit or loss. Now, this basically how we compute that goodwill using the partial, using the full goodwill method. But equally in an exam, the examiner will not tell you use full goodwill method. The examiner will never tell you that. So mostly in the additional information, you will come across this information. You'll be told that it is the policy of the group. Policy of the group. It is the policy of the group to do what? To measure NCI at fair value. To measure NCI at fair value. In which case the examiner will proceed and give you something called the NCI at fair value. NCI at fair value is given or will be given, that is. Will be what? Will be given. Will be given. So the examiner will give you this, the NCI at fair value. He will tell you the NCI at fair value on the date of acquisition was this particular amount, was this amount. So therefore, once or for you to use the full goodwill method, usually you'll come across this particular information in the additional information. It is a policy of the group to measure NCI at fair value, and the examiner will move or basically will proceed and give you the fair value at the NCI at fair what? At fair value. So therefore, that is basically very, very important as far as the computation of goodwill is concerned. We have said goodwill is the difference between purchase consideration paid and the fair value of net asset acquired. How many methods can be used by the company in the computation of goodwill according to IFRS, full goodwill method and the partial goodwill method? You must be able to know how do we compute the goodwill using the full goodwill method and also the partial goodwill method. But here there is something which is very, very important, which I've said the examiner on. No question for group accounts. You'll be given that, and that is basically the fair value of the subsidiary company net asset on the date of acquisition. That is something which the examiner will not have given you in most of the questions, or actually in all questions. How do we compute that? How do we compute this? The fair value of subsidiary company net assets on date of acquisition. On date of acquisition. And basically this is the date the parent company acquired the subsidiary. So that in short form we abbreviate it as DOA. DOA. So anytime you hear of DOA, is basically the date there was what? There was a DOA. A DOA is basically a wedding. Is the date these two companies came together. Is the date this company did what? Acquired the subsidiary. The date of acquisition. So basically, this is something you will never be given in an examination. Now, net asset generally, net asset here, net asset, there are two approaches we can compute this. You can take asset of the company minus liabilities. That will give you net asset. Alternatively, you can compute net assets by taking equity of the company. Equity we know is the share capital. Share capital plus reserves. Plus what? Reserves. In group accounting, we compute the net asset of the subsidiary using the second formula. We don't use the first one. We don't use this one, asset minus liabilities. We use this one, where we take the share capital of this company automatically on the date of acquisition, and then we add the reserves of this company on the date of acquisition. So therefore, this one is equal to the subsidiary company ordinary share capital plus something called the pre-acquisition reserves. So what do you mean by the pre-acquisition reserve? Pre-acquisition reserve, these are basically the reserves of the subsidiary, or the reserves the subsidiary company was having on the date it was acquired. On that date, when the parent company acquired the subsidiary, which reserves were in the books of account of the subsidiary on the date of acquisition. And actually, we know the reserve comprises of things like the retained earnings, the share premium, and so on. So therefore, to compute this one, what we do is that we take the subsidiary company, ordinary share capital, and then to this we take the pre-acquisition retained earnings. So this is the retained earnings of the subsidiary on the date it was acquired. We also add the pre-acquisition share premium, the pre-acquisition revaluation reserve. Let me have that here. The pre-acquisition revaluation reserve, a pre-acquisition revaluation reserve, and basically we add all this. So this now will give us the fair value of the subsidiary company net asset on the date of acquisition on DOA. So this is very, very important. When it comes to the computation of the goodwill, this is where majority of the students have a challenge. They are not able to compute the fair value of the subsidiary company net asset on the date of acquisition. So we compute it using that formula. A subsidiary company ordinary share capital plus the pre-acquisition reserve. These are the reserves the subsidiary company was having on the date of acquisition. On the date of what? Acquisition. So therefore, as far as the computation of goodwill is concerned, basically those are that's what you need to know. What is goodwill and the two methods of computing the goodwill, and equally this one. How do we deal with this? How do we deal with this? Now next, I want us to look on this one, forms of purchase consideration. Forms of purchase consideration. Forms of purchase consideration. Now, purchase consideration, first of all, remember you have said that this is what the parent company pays after acquiring majority of the shares in the subsidiary. So automatically you have said that once this company acquires majority of the shares of the subsidiary, the parent company must pay for those shares acquired. The same case, if you buy shares in a company, you must pay for those shares. Now, the purchase consideration paid by this company can take various forms. So the first form of purchase consideration is something called a cash consideration. The cash consideration. Basically, cash consideration, this is a consideration which is paid in cash, and also it is paid on the date of acquisition, on the date of DOA. So is where the parent company acquires the majority of the shares in the subsidiary, it pays for those shares in cash, and that payment is made on the date of acquisition. Now, this particular consideration here has no special treatment. When it comes to the computation of goodwill, so this particular consideration has no special treatment. So we use that the amount that it is. So if you are told the parent company paid acquired 80% of the shares in B, paid a cash consideration of 100 million. When computing the goodwill, you use the amount, you use that consideration as 100 million. You use it as 100 million. That's why we are saying that consideration has no special treatment. Number two, we have a deferred consideration. A deferred consideration. So what do you mean by a deferred consideration? Basically, we know to defer is to postpone something to it in the future. So this, number one, is a consideration to be paid in future from the date of acquisition. So this is a consideration payable in the future. Consideration payable in the future. For example, in this case, we may be told that 𝐻𝐿 acquired 80% of the shares in B, but this company promised to pay an additional consideration of maybe 200 million in 2 years' time. So mean that this particular amount here will be paid at the end of the second year from the date the parent company acquired the subsidiary. Now, this amount here, which is to be paid at the end of the second year from the date of acquisition, remember it forms part of the purchase consideration. When computing the goodwill, which has to be computed on the date of acquisition, this amount has to be used because it is part of the purchase consideration. Therefore, as such a consideration which is payable in the future, this one has to be discounted. This one is discounted to its present value, using the parent company cost of capital. Using the parent company cost of capital. So the parent company cost of capital essentially would be your R. We know that whenever you're discounting, whenever you're getting a present value, you must have this one. You must have a discount rate. So in this case, you will always be given the parent company cost of capital. You discount it. Like in this case, let's assume that we are told company A acquired 80% of the shares in company B, and this company here promised to pay an additional consideration of 200 million, and this will be paid at the end of the second year. From the date of acquisition. Basically means from the date of acquisition, this amount of 200 million will be paid at the end of the second year. We are saying because this particular amount must be used in the computation of goodwill, and we compute the goodwill on this date, we can only use it on a we can only discount that amount to its present value. To do that, we use the parent company cost of capital. And then in this case, we are told that the parent company cost of capital, and the parent company cost of capital is maybe 10%. 10%. So how do we discount this one? How do we get the present value of this deferred consideration? So the present value of the deferred consideration will be equal to 200 million. 200 million. We multiply that with the present value interest factor at the rate of 10%, and basically for 2 years. For 2 what? For 2 years. That amount will be received, will be paid after 2 years. So we take 200 million, we multiply this with the formula, or basically with this present value interest factor. So in this case, you have to recall, how do we compute this? It's something you did in FM. We take 1 plus R raised to power negative, and remember, this is not an annuity. This is just a single amount. These are a single amount to be received after 2 years. So that is the formula which we use here. So 1 plus R, which is 10%, it will be 1.1. 1.1, we raise that to power negative 2. So our end there will be 2 years. So this will give us now the present value of the deferred what? Consideration. The present value of the deferred what? Consideration. So maybe you can work out this 1.1, which is raised to negative 2, raised to power negative 2, and this will be 200 million times 0.8264. 8264. I hope that is what you're getting. So we multiply the 2.8264 times 200. So this will give us 165.28 million. So when computing the goodwill, this deferred consideration, which is a consideration to be paid in future, we don't use it as 200 million, but basically in this case we are saying we get its present value. Its present value will be 165.28 million. So any consideration to be payable sometime in the future must be discounted to its present value using the parent company cost of capital. Then we have the other consideration, because we have 3 main forms of purchase consideration. We have the last one, which is called the share exchange consideration. The share exchange consideration. Share exchange consideration. So what do you mean by the share exchange consideration? So this is a consideration which is paid by the parent company by issuing its own shares. The parent company issue its own shares as a form of payment. It is important for you to note that whenever a company is paying for an asset acquired, for services provided, for goods purchased, the company can pay for those goods, or the company can make the payment in cash, or the company can issue its own shares as a form of payment. You see, share is an asset. So instead of the company paying for goods or services in cash, the company can issue its shares as a form of payment. In the same case, once the parent company here acquire majority of the shares in B, so the parent company can issue its own shares as a form of payment. So therefore, this is a consideration paid. Paid by the parent company issuing its own shares. Issuing its own what? Its own shares. In most of the questions whereby the purchase consideration was in form of a share exchange, the examiner will tell you that the parent company had not computed and accounted for the share exchange consideration. So therefore, how do we compute the share exchange consideration? The share exchange consideration. So how do we compute this? So the share exchange consideration one, this one is equal to number of shares issued by the parent. issued by the parent company. So how many shares did the parent company issue to pay the purchase consideration? And then we multiply those shares with their fair value, or basically with their market price, on the date of acquisition. On the date of what? Acquisition. In other terms, we multiply this with the parent company shares fair value or market price on the date of acquisition. Because in most of the questions for group account, so the examiner will confuse you by giving you the market price of these two companies, the market price of the shares of these two companies on the date of acquisition. So in case you're given the market price of the shares of the parent, the shares of the subsidiary, what do you use here? You use the market price of the parent company shares, because here you are dealing with the shares issued by the parent. You must multiply that with the parent company market price per share on the date of acquisition. On the date of what? Acquisition. So once you have computed this share exchange consideration, you will also be told that the parent company had not accounted. The parent company had not accounted for those shares which were issued. Which accounting entries are made here? Which accounting entries are made? So we can look on the accounting entries which are made to account for these shares which were issued by the parent company. So number one, so we debit an account which is called the cost of investment. The cost of investment. So the cost of investment, basically, this is an account whereby the parent company records the purchase consideration which was paid in acquiring a majority of the shares in the subsidiary. If the purchase consideration which has been computed here is 200 million, it should be debited in this account. And then the parent company issued shares to pay this. So therefore, what we do is that we credit the parent company ordinary share capital. And in this case, you have to recall the amount which is credited in this account. That is something we covered in the topic of published financial statement. The amount which is credited in this account is always based on the par value per share. Par value per share. You see, we have seen when computing this, we compute this based on the fair value per share, the market price per share. So market price and the fair value are two different values. So market price is the value at which the shares of the company are trading in the securities exchange market. The par value per share is the value of the share as stated in the capital clause of MOE. So those are two different values. The amount we credit here has to be equal to the par value. And therefore, if the market price per share is higher than this, the amount which is above the par value, then that one should be credited in the parent company share premium account. Share premium account. If, for example, the shares had a market price of 15 shillings, on the date of acquisition, if the shares of the subsidiary if the shares of the parent company had a market price of 15 shillings per share, and the par value per share is 10, so you can see the shares were issued at a price of 15, but the par value is 10. So the amount we credit in this account is always based on the value of the par value of shillings 10. And therefore, the share premium per share here will be equal to the issue price 15 minus the par value. So that is something you have to recall from what you did in the topic of group account. So therefore, we have those as the various forms of purchase consideration, the cash consideration, the deferred consideration, the share exchange consideration, and basically how we deal with those considerations specifically in computation of group accounts. Maybe we can just pick up one question of the group account and maybe see whether we can be able to get a question with this aspect of share exchange. We have a number of them. And then we see how do we compute this share exchange consideration? How do we account for this? So we are not doing the entire question for group account, but I want us to look on a question having the aspects of share exchange consideration. We look on how to compute the same, and equally how we account for that share exchange consideration. So we're going to look on the first question here. Yes, can we go to this question here for August 2023? We are not doing automatic, we are not doing the entire question for group account, but basically I want us to look on this aspect of share exchange consideration, how we compute the same, and how do we account for that. So we go to this one, to this question here, August 2023, question number 3. So specifically, the first paragraph, what is it? Yes, first paragraph of that question. So basically, I've said if you go through the past papers, you'll be able to see a question on this topic. This is basically a compulsory question. The compulsory question in this paper for a fact. So if you are there, please confirm. I want us to just go through that first paragraph. We see what was required. And basically, we compute that share exchange consideration and we show how it was supposed to be accounted for. I hope you are there. I hope you are there. Yes. So what are we told here? What are we told? What are we told? What are we told here? What are we told? So we are told that 𝐕𝐶a Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, 𝐕𝐶a Limited acquired 75% equity interest in 𝐍𝐶 Limited under the following terms. Now, once you come across a question for group accounts, the first thing you do is basically to come up with something called a group structure. A group structure is what? A group structure is basically a form of a diagram which shows the parent company shareholding in what? In the subsidiary. And in that structure, you must be having the percentage shares acquired by the parent in the subsidiary, and also you must be having the date of acquisition. For example, from that information, we are told that this company, which is called 𝐕𝐶a Limited, wants to expand its operations. And we are told, therefore, this company acquired on, that is sentence 2 of first paragraph, on 1st of November 2022, this company acquired 75% equity interest. Equity interest means that this company acquired 75% of the equity or ordinary shares of the company which is called 𝐍𝐶 Limited. This basically what we refer as a group structure. From this group structure, we can tell that this is the parent company, that is our subsidiary, and then the date we have here, this is the date we have referred as the date of acquisition, the DOA, the popular date of acquisition there. Yes. So this is the parent, this is what? The subsidiary. So that we refer to it as the group structure. So we are told this acquisition of 𝐍𝐶 was under the following terms. One, we are told there was an immediate cash payment at a fair value of shillings 13 per share on 1st of November 2022. This is an immediate cash payment. An immediate cash payment, this is what you have referred to as a cash consideration. You have said there is no special treatment as far as that is concerned. Therefore, that is not our interest as far as this question is concerned. I want us to go to the other point where we are told, remember these are the terms of payment, the terms of acquisition. We are told there was an immediate cash payment. Point 2, we are told an issue of 3 ordinary shares of shillings 10 par value in 𝐕𝐶a Limited for every 5 shares which were acquired in 𝐍𝐶 Limited. So this company here was to issue some shares as a form of payment. And then you're told the fair value of Pika Limited shares for shillings 13 per share at the date of acquisition. The share issue has not yet been recorded by Pika Limited. So that is basically the point I want us to deal with. So we are told that when this company acquired 75% of the shares in Shiba, there was an immediate cash payment, which basically have referred to the cash consideration. That is not our interest. And then we are told that this company also issued some shares to pay the purchase consideration. That is basically what we refer as the share exchange consideration. And then in the last sentence of that point 2, we are told the share issue has not yet been recorded by Pika. This company issued shares to pay the purchase consideration, but has not yet recorded that. It has not yet accounted and recorded the shares which were issued. In other terms, what you must do as far as that point is concerned is to compute the share exchange consideration. Share exchange consideration. We have said this one is equal to the number of shares which were issued by the parent company. This formula is very, very important. How many shares were issued by this company? And then you multiply those shares with the parent company shares fair value or market price on the date of acquisition. On the date of acquisition. So in this formula, the examiner will always have given you this. Will always have given you this. For example, if we go to that point number 2, have we given the fair value of the parent company shares on the date of acquisition? Who can see that price? Actually, that should be in sentence 2. Sentence 2, where we are told the fair value of Pika Limited shares for shillings 13. For shillings what? 13. Remember, Pika is the parent. So what is the parent company's share fair value or market price on the date of acquisition? So we are told the fair value of Pika Limited shares for shillings 13 at the date of acquisition. So this one is already given as shillings what? 13. No problem with that. So the problem comes here. So this one is something which the examiner will not have given you. How do we compute this one? We go back to the same point in the first sentence. We are told an issue of 3 ordinary shares of shillings 10 par value in Pika Limited. In other terms, Pika Limited was to issue 3 shares. And basically, you're told the shares which were to be issued, they had a par value of 10 for every word. That is now the other important information. For every 5 shares which were acquired. For every 5 shares which were acquired. This company was to issue 3 shares for every 5 shares which were acquired. In this case, what we need to do, first of all, is to determine how many shares did the Pika Limited acquired in Shiba. That is the first thing we need to determine. So how do we determine the shares issued by this company? So to determine the shares issued by this company, you go to its statement of financial position, specifically at the equity. That's where you can be able to get information about what? The ordinary share capital of this company. You take the share capital of this company, this what we are doing in the topic of publish. You take the share capital of this company, the share capital, you divide that with the par value. That will give you the shares issued by Shiba. So definitely, if you go below there, you'll be able to see we are given the statement of financial position of the 2 companies. Can you give me the share capital of Shiba? The share capital of Shiba, which is the subsidiary. Give me the share capital of Shiba. I see whether you can be able to get that information. The share capital of Shiba. Share capital of Shiba. What are you getting? What is the share capital of Shiba? The capital of Shiba. I need to get that answer from each of you. I've only gotten the answer from Helen. I need to get the answer from Martha, from Aaron, from Zipporah, from Virginia, from Hassan. So can you give me the share capital? Can you give me the share capital of Shiba? The share capital of Shiba, this company, is 80,000. Still in the balance sheet, where we have the one ordinary share capital, I hope you can see we are told the value of each share is 10. That applies to the shares of Pika. That also applies to the shares of Shiba. So to determine the shares issued by this, we take its share capital divided that with the par value, which is 10. So the shares issued by this company, that is Shiba, are 8,000. So what are we interested with here? We're interested with the shares Pika acquired in Shiba. And you have to be very keen here. So the parent company didn't acquire all the shares. The parent company only acquired 75% of the shares. So the shares acquired by Pika in Shiba will be 75% of the shares issued by Shiba. So this company has acquired 75% of the shares of Shiba. The shares of Shiba are 8,000. So this will give us what? This will give us what? Will this give us 6,000 shares? 6,000 shares? 0.75. Yes, 6,000 shares. 6,000 shares. And we say, please try to hurry up because of time. Computation of that should not even take 3 seconds. 0.75. 0.75 of 8,000. What are you getting here? Yes, what are you getting? Yes, so this will give us 6,000. This will give us 6,000 shares. So the shares acquired at 6,000. So what we need to do is basically to determine the shares which were acquired. Sorry, the shares which were issued by this company. Sorry, the shares issued. So we cross multiply and we divide. So we will take 3 times the shares which were acquired as 6,000 divided that with 5. Divided that with 5. So this will give us what? So 1, 12. So this will give us 3,600 shares. So that is 600 shares. 600 shares. That is 600 shares. These are basically the shares which were issued by who? By Pika Limited. That's basically what we wanted to compute. The shares which were issued. So having done, then we can move and we compute the share exchange consideration, which will be equal to this. The shares which were issued by the parent company, that is 600 shares. We multiply those shares with their fair value, which is 13 shillings. 13 shillings. And this will give us a share exchange consideration of how much? Share exchange consideration of how much? That is 600 times 13. That will give us 46,800. 46,800. Yes. So that's basically how we compute that share exchange consideration. Then, how do we account for this share exchange consideration? The accounting entries. The accounting entries. How do we account for this share exchange consideration? So we have said we debit something called the cost of investment. The cost of investment. The cost of investment would be 46,800. And then in this case, we have said we credit the parent company ordinary share capital. So to credit share capital is to add. That's what we know. We credit the parent company ordinary share capital with an amount equal to the par value. So we take the shares which were issued by the parent company, which we know they were 36, and then we multiply that with the par value per share. Who can tell us what is the par value per share? What is the parent company? What is the par value? The par value of the parent company shares. This is the value we have within the balance sheet. The value we have within the balance sheet is what? Is 10. So the amount to be credited in the parent company share capital will be 36,000. And because the shares were issued at a market price of 13, the amount which is above 10, which is 3 shillings, that is a share premium. So that share premium will be credited in the parent company share premium account. So the amount to be credited in the parent company share premium account will be equal to the shares issued by the parent company times the amount of premium. The premium per share is 3 shillings, the amount which is above 10, So that will give us what? Give me the amount of the share premium. The amount of the share premium. So the share premium here will be 10 what? 10,800, will be 10,800. So that's basically how we compute and then account for something called the share exchange consideration. That's how we compute and account for the share exchange consideration. This is kind of very, very common concept as far as this particular question for group accounts are concerned. I want to give another question, which basically will be taking as an assignment. This one, December 2022. December 2022. Okay, just go to this question. I can see we have, I want us to end at 3:40. I can see we have like 7 minutes. So can you go to this question here? December 2022, which is basically question number 3A. We try to hurry up. I want us exactly by 3:40. 3:40, we end our class. I know you have maybe another class after this. I want you to take a short break before you start the other class. That's why even I've not given you a short break. I want you to give you a short break of 20 minutes before you join the other class. You have this question with you? If yes, please confirm. If yes, please confirm. Please confirm. I will be able to proceed reading that question. I hope you already have there. You already there. So what are we told? We are told that specifically we go to the first paragraph. We are told on 1st January 2022, H Limited acquired 80% of 4 million shillings 10 ordinary shares of S at par value. And then you're told the acquisition consideration consisted of 3 shares issued by H Limited in exchange for every 5 shares in S. So that is a share exchange consideration. And then you're told additionally, H Limited pays a further consideration on 31st of December 2022 of shillings 11 per share acquired. And then you're told H Limited cost of capital is 10%, and the discount factor at 10% is 0.9091. So that is still that is a deferred consideration, a consideration to be paid in the future. So we are told at the date of acquisition, the fair value of the ordinary shares of H and S were 15 and also 12. So in that case, we have two considerations. I want us to deal with both of them. We have the deferred consideration and basically the share exchange consideration. The share exchange consideration. So maybe we can start with this one, which we have said to compute this, we have to determine the number of shares which were issued by whom? Which were issued by the parent company. How many shares were issued by the parent company? We multiply those shares with the parent company fair value. That is the parent company shares fair value or market price on the date of acquisition. So let's first of all, we will compute this one. So we go back to the information we have in paragraph 2, and I think there is something I've forgotten here. Remember, you have said that once you come across a question for group account, the first thing you should have always is the group structure. Basically, for you to know out of those two companies, which company is the parent and which company is the subsidiary. Maybe first of all, we can have that here, the group structure. And basically, we are told that in the first paragraph, we are told on 1st January 2022, H Limited acquired 80% of 4 million ordinary shares of shillings 10 of 𝐎𝐍 Limited. And basically, the acquisition took place on 1st of January 2022. It basically means that this is our parent company and this is our subsidiary. And this date which we have here is the date of what? Acquisition. That is very important. Very, very important. So having this, let's go back to paragraph 2. And we are told the acquisition consisted of a new issue, and consisted of 3 new ordinary shares issued by H. So we need to compute this because this one is already given. So how many shares were issued by H? So we are told H Limited was to issue 3 shares. 3 shares for every what? For every 5 shares which were acquired. For every 5 shares which were acquired. So in this case, we have said we need to determine how many shares did H acquire in S. So if you check on the information we have down here, you'll be able to see that we don't have the statement of financial position of S, meaning that we can't be able to get the shares issued by S in its balance sheet. But if you go back to paragraph 1, you read that point well, you'll be able to see we are given the shares issued by S. And we go back to paragraph 1. We are told on 1st January 2022, H Limited acquired 80% of the 4 million shillings 10 ordinary shares of S. So the shares issued by this company S are 4 million. That information is given. So therefore, we need to determine how many shares did H Limited acquire in S. The shares acquired would be 80% of the shares issued by S. That is 4 million. 4 million. And basically, this will give us 3.2 million shares. 3.2 million shares. So we want to determine the shares which were issued. We cross multiply, then we divide. We have 3 times 3.2 million. We divide that with 5. So this now will give us the shares which were issued. This will give us what? This will give us what? Yes, I'm given that figure in 1,000 of shillings. In 1,000 of shillings, I'm told that this one would be 1920 shares, but in 1,000 of shillings. So having that, what would be our share exchange consideration? We take this one, which are the shares which were issued, 1920. We multiply that with the parent company share fair value on the date of acquisition. And actually that information, we have it up there in paragraph just above the statement of profit or loss. So we are told there is a paragraph which reads, at the date of acquisition, the fair value of ordinary shares of H and S that is the fair value of the ordinary shares of H and S was 12 and was 15 and 12. So what we're interested with here is the parent company shares fair value. Is that 15 or 12? On the date of acquisition, what is the market price of H Limited shares? Is it the one which is 15 or is it the one which is 12? 15 or 12? That one is 15, is 15. So this is how we compute the exchange consideration. Exchange consideration. Times what? Times 15. So this will give us 28,800. 28,800 what? 800. So that is the share exchange consideration. The share exchange what? Consideration. The share exchange consideration. Then, and we deal with this one. the deferred consideration, we go back to the information we have in paragraph 3. We are told additionally, H Limited, which is the parent, this one, additionally, H Limited will pay a further consideration on 31st of December 2022. So remember, the date of acquisition is 1st January 2022. We are told this company will pay an additional consideration on this date. Basically, you can see this exactly after 1 year. After one year? So that is a deferred consideration to be paid 1 year after acquisition. So we are told it will pay a further shillings 11 for every share acquired. So we need to compute how much amount will be paid. It will be equal to 11 shillings for every share acquired. So how many shares did H Limited acquire in S? I hope you can remember you have computed that down here. The shares acquired by H in S, we have said were 80% of 4 million. So the shares H Limited acquired in S were how many? 3.2, this one. So therefore, the amount to be paid after 1 year will be 11 shillings per every share acquired. We take 11 shillings times the shares which were acquired. So this is the consideration to be paid after 1 year. We multiply that with the present value interest factor, at which rate we are given the parent company cost of capital, which is 10%, and basically this will be paid after 1 year. Will be paid after 1 year. Yes. And I think in our case, this figure is already given for us. Is given because in terms of how we compute this, we should take 1 plus R raised to power negative, and it should be 1.1 raised to power negative 1. And this is the one which should give us 0.9091. And basically that is what you're given. Is that what we should get there? Maybe you can just confirm. 1.1, we raise that to -1. Yes, it should give us that. So therefore, the present value of the deferred consideration would be equal to this. Will be equal to this, which is what? 11 times 3,200, and that will give us 35,200. So basically, whatever you get here times this, and basically it is equal to that. So what are we getting here? Times 0.9091. So basically, in that case, I'm getting the present value of the deferred consideration as that amount. So as that amount. If you work out with this one, Aaron, if you work out with that, it should give you exactly 32,000. 32,000. 32,000. Are you getting that? Yes, 32,000. So basically, that is how we deal with that particular aspect of deferred consideration and also the share exchange consideration. So once we meet now in our next class, we will be able to proceed and basically look on how we prepare the consolidated financial statements, specifically whereby the parent company has invested in what? In a subsidiary. So therefore, for today, I want us to stop at that point. We will continue from there in our next class. But even before we meet, can you ensure you are grouped on what you have discussed today? Yes, because it is very, very important. Goodwill and also the various forms of purchase consideration. So have a nice weekend. Let's continue from there on Tuesday. Yes, so I want us to continue from where we reached in our previous class, and we started on this topic of reconstruction stroke reorganization. And basically, we said a company is reorganized or basically restructured if a company has been making losses for a number of years, or basically the company has been experiencing financial distress. In this case, we said there are two ways in terms of how the company may be restructured. We talked about the internal reconstruction, which is also known as a capital reduction. And number two, we talked about the external reconstruction, merger, and also what absorption. So what we were able to do in our previous class, we discussed what is internal reconstruction, which we said this basically entails reorganizing the capital structure of the company. Number one, by writing off the accumulated losses, basically reducing the share capital, and also doing what? Revaluing the asset, and basically trying to reduce the liabilities of the company. And actually, we said to account for the internal reconstruction is quite simple. We just apply the concept of double entry. And the main account which is prepared, we said, is a capital reduction account. So in today's class, I want us to move and basically we look on what is external reconstruction, merger, and basically absorption, and how do we account for this? How do we account for this? So we will start by defining these three terms here. That is external reconstruction, external reconstruction. We basically see what this entails. We also define what is merger, and basically this one is also known as amalgamation. Then number three, we also define what is absorption. So to start with the external reconstruction, basically this whereby a company which has been making losses or which has been going through financial problems or through financial distress will be liquidated, and basically its operation or its business, assets and liabilities taken by a new company which will be formed for that purpose. So here, the company which has been going through financial problems, assuming it is company X, this company will be liquidated, and basically its business, assets and liabilities will be taken over by a new company, say company Y. So meaning that this is a new company, basically which is formed to take over the business, assets and liabilities of this company which has been experiencing financial troubles, or basically financial financial challenges, or basically which has been making losses. So therefore, in case of external reconstruction, once this company is liquidated, then its business and assets will be taken over by a new company, company. Now, this one is almost the same with this, but there is a slight difference. In case of absorption, basically what happens is that the business and also the assets and liabilities of a company which has been making losses will actually be taken over by an existing company. So meaning that the company which has been making losses will be liquidated, or basically will be wind up, and then its business operation, assets and liabilities will be taken over not by a new company, but will be taken over by an existing company. So therefore, in this case here, the company which has been making losses, assuming it is company X, and this company will be liquidated, and then its business operation, assets and liabilities will be taken over by a company, say company Y. And in this case, we are saying this is not a new company, but basically we are saying that this is an existing company. I hope therefore you can see the difference between external reconstruction and also absorption. So here the business, the assets and liabilities of this company which has been liquidated will be taken over by a new company. But in this case, the business, assets and liabilities of this company which is being liquidated will be taken over by an existing company. That is the difference between external reconstruction and absorption. So what do you mean by merger, or basically amalgamation? Amalgamation or merger, we know that this whereby two or more companies will be able to do will actually be merged into a single company, company. So assuming we have two companies here, maybe company A and company B, these two companies have been making losses, or maybe these two companies have been experiencing financial distress. The shareholders and also the directors of these two companies agree to do to liquidate the two companies, agree to liquidate the two companies. their business operation assets and liabilities to be taken over by a new company which will be formed, maybe say company X. So meaning that here a new company will be formed, basically to do what? To take over the business operation, assets and liabilities of these two companies which are being what? Liquidated. So therefore, in case of a merger or amalgamation, we say that the identity of these two companies will be lost because those two companies will be liquidated, and then a new company will be formed to take over the business operation, assets and liabilities of these two company. And basically a good example of a merger, we have a merger which happened in the banking sector some time back, the merger of two banks. The first bank was NIC, and the other bank was CBA. So these two banks merged, and the new bank which was formed after the merger is currently known as what? The NCBA. N's what? CBA. So this is basically a bank which was formed after the merger of two banks. So we are saying the identity of these two banks or the identity of the two companies which are merging will be what? Will be lost, and basically a new company will be what? Will be formed. Now, if you have noted from all these particular definition, there is something which is common in all these forms of reconstruction. So one thing which is common is that this company which has been making losses, or in case of merger, the two companies which have been making losses, we are saying they will be liquidated. That is something which is common here. So once they are liquidated, then we are saying their business operation, assets and liabilities will either be taken over by a new company or by an existing company. That is also something which is common. And therefore, how do we account for this external reconstruction, merger and absorption? So to account for these three forms of reconstruction, we account for them in the same way. So here we make two sets of accounting entries to account for this, and equally in this case, we account for this using the concept of double entry. So we make two sets of accounting entries. One, we make the first set of accounting entries to do what? To cross off the books, of account of the old company. This company which is being liquidated, we refer to it as the old company. In other terms, we refer to this company as the selling company. Why do we refer to it as the selling company? Is because once it is liquidated, then it is deemed to have sold its business to a new company, or is deemed to have sold its business to an existing company. So the old company which is being liquidated is known as the old company, or is known as what? The selling company. So here, which are the main accounts prepared here to cross off the books of account of the selling company? Even before you look on the journal entries or the accounting entries, so here there are how many main accounts prepared? I think they should be 3 or 4. So the first one is called the realization account. And even before explaining these accounts here, there is something you did similar to this. If you can be able to recall in financial reporting and analysis, you did a topic for the conversion of a partnership into a limited liability company. Now, that aspect of converting a partnership business into a company is the same with this concept here. Because once you're converting a partnership into a company, a partnership was being dissolved, and then a new company was formed. So what we were doing in FR, we were crossing off the books of account of the partnership by preparing a number of accounts, including realization and opening the books of accounts of the new company, the same aspect which is applied here. So if you understood that topic of converting partnership into a limited liability company, this is the same. The same concept applies here. We have to cross off the books of account of the old company. We prepare 3 main accounts: realization account, ordinary shareholders, sundry members account, The other account is called the preference shareholders, sundry members, account. And also there is another account which is prepared, known as the purchasing or the new company, account, the new company account. So those are basically the three accounts which are prepared, basically to do what? To close the books of account of the old what? Of the old company. Do I give the journal entries, or basically do I give you what is recorded in each of these accounts? Let me give you what is recorded in each of these accounts. I think that one is a little bit simple for you to understand. So I want us to look on what is recorded in each of these accounts. So basically, you can have our four accounts here. Our four accounts. Basically, we are saying that these are the accounts which are prepared to close off the books of accounts of the owned or the selling company. The first account is the realization account. Realization account. What do we record in this particular account? The realization account. On this side, first of all, we record the assets. The assets which are taken over by the new company, at their net book value. So once the old company has been liquidated, some of the assets will be taken over by the new company. So those assets which are taken over and at their net book value, because it is important for you to note that whenever the assets are taken over by the new company will take them over at their current market value, at their fair value. But when closing off the books of account of the old company, we record those assets here at their net book value, not at their fair value. Then the other account, maybe you can have it here, ordinary shareholders, salary members account. Now in this account, we have those particular assets which will not be taken over by the new company, especially the intangible assets, like the goodwill, the patents, they will not be taken over by the new company. So we say those are the assets which are written off. So they are those particular assets which are written off. So those particular assets which are written off at their net book value, they are basically debited here. So in that case, you can see from the statement of financial position of the old company, we have dealt with the asset. So the asset of the old company can either be taken over or written off. Then from there, after closing off the asset account in the books of account of the old company, we go to the share capital and reserves. Share capital and what? Reserves, and then liabilities. Now, for the liability, for the ordinary share capital, that is ordinary share capital and reserves. So what we record here on this side is the ordinary share capital. So remember, this company will be having ordinary share capital. So the ordinary share capital of the old company is crossed off to this account, basically credited here, plus any reserve. Plus any what? Reserve, e.g. the share premium. So because here you need to remember that a statement of financial position of a company, what is recorded there? Assets. From there, we have what? Equity. From there, we have what? Liability. So when closing of the books of account of the old company, you close these items systematically. Don't skip any. You start by closing the asset. And I've said for the asset, we have those assets which are taken over. The other asset may be written off. Asset taken over at the net book value, debit them there. Assets which are written off at the net book value, debit them here. And then you go to equity. Equity, we are saying this comprises of share capital and reserves. So the ordinary share capital and reserves, they are credited here, except the accumulated losses. The accumulated losses, that one should be debited in this account. Remember, the company which is to be liquidated will be having accumulated losses. So then from there, still at the equity, we may be having preference share capital. So the preference share capital is crossed off to an account which is called preference shareholders, salary members account. Salary members what? Account. Salary members account. So on this side, we record the amount of preference share capital. The amount of preference share capital. So once we are done with that, we proceed to the liabilities. So for the liabilities, we have those particular liabilities which will be taken over by the new company. So the liabilities which will be taken over by the new company. So the liabilities taken over by the new company, those liabilities are basically credited here. The liabilities which are taken over, and always the liabilities are taken over at their net book value. Liabilities are not revalued. If the old company had a bank overdraft of 2 million, you cannot revalue a liability. It will be taken over at 2 what? At 2 million. At 2 what? At 2 million. At 2 million. Then, after closing off those particular accounts which had balances here, there are other items which you may also be required to account for, which are not part of this. They are given in the additional information. One of it is something called the preference dividend in arrears. So the amount of preference dividend in arrears is basically debited here and then credited in this account. A preference dividend in what? In arrears. So that is a double entry. Debited there, credited there. And then number two, we also account for something called the purchase consideration. Remember, you have said that once the new this old company is liquidated, and basically its assets, liabilities, and business operation taken over by a new company. So this company will be deemed to have purchased the business of this. So this company here will pay purchase what? Consideration. So with the purchase consideration which is payable, the purchase consideration which is supposed to be paid, we credit it in this account, and then we debit it in this account here, which is called the purchasing company account. So credited there and then debited here. The purchase consideration. The purchase consideration. The other item which you also account for is something called the liquidation cost. So because this company is being liquidated, there will be some liquidation cost which will be incurred. Mostly this liquidation cost is paid by the new company here. Is paid by the new company. So that liquidation cost which was paid, liquidation cost paid. So we debit it in this account and then we credit it in this. We credit it in this account, the liquidation cost, And then finally, what now we need to do is basically to account for the last item, and that is the purchase consideration paid. So the purchase consideration which will be paid by this company, and that is the new company, it will have to be paid to the owners of this company. Who are the owners of this company? The owners of this company are the ordinary shareholders and the preference shareholders. So the amount of purchase consideration which is paid to the ordinary shareholders, that one will be debited in this account. So the purchase consideration paid. How much purchase consideration was paid to the ordinary shareholders? Debited there, and then we credit it here. So purchase consideration paid to ordinary shareholders. Then from there, we have the purchase consideration which is paid to the preference shareholders. So purchase consideration which is paid to who? To the preference shareholders. So debited here and then credited here. Purchase consideration which is paid to who? To the preference shareholders. To the preference shareholders. To the preference who? Shareholders. To the preference shareholders. And then from there now, what we do basically is to balance this account. No, we start by balancing these two accounts here. So remember, if we are the owners of the company and basically we have accepted to sell our company, we can sell that company at a profit or at a loss. So therefore, the balancing figure here in these two accounts is basically a gain or a loss. So for example, in this case, if you get a balancing figure on this side, basically that one is what? It basically means that whatever was paid here is like more than the amount of money which the shareholders were expecting. So that one, a balancing figure on this side will be close to this account, and basically that one is what? Is a gain. is again, so the balancing figure to this account should be crossed off to this. You can get the balancing figure on this side. You cross it off to realization, which basically will be what? Will be a loss. The same case here. So any balancing figure here should be crossed off to the realization account. It can either be on that side or basically on this one, on this side here. But this particular account here, this one should automatically balance. This account should not have any balancing figure. This one should not have any balancing figure. And then this account here, you then balance it. So from the balances which you have gotten here. So you can have a balance from this account, the preference shareholders, salary members account, which can either be on this side or that side. And a balancing figure from the ordinary shareholders, salary members account, which can either be on this side or that side. Once you have done that, that account should automatically balance off. That account should automatically balance off. So therefore, what is important for you to note is that in crossing off the books of account of the owned or the selling company, those are the main accounts which we prepare. This one, the realization, the ordinary shareholder salary members account, the preference shareholder salary members account, and the purchasing company account. So in most of the questions you'll come across, the examiner will basically require you to prepare like the first three accounts. The first three accounts. Then, once we have crossed off the books of account of the old company, the next thing we proceed to do is to open the books of account of the new company. We proceed and we open the books of account of the new company. And in doing that, in opening the books of account of the new company, the main account which is prepared is an account which is called the business purchase account, just like what you are doing in that topic of converting partnership into a limited liability company. So we have accounting entries in the books of the new company, in the books of the new company. The new company, in other terms, this one can also be known as the purchasing company. The purchasing company. In this case, I've said we have two main accounts which are prepared. The first one is called the business purchase account. The business purchase account, and another account which is called the selling company account. The selling company account. Maybe in this case, we can look on the accounting entries which are made. So here, majorly, we account for three main items. We account for three main items. I say three, I think like three main items. One, we account for the assets which were taken over. The assets which were taken over, or which in this case, when accounting for the assets which were taken over in the books of account of the new company, we account for those assets at their fair value. At their fair value. The fair value is the current market price. So how do we account, or what is the accounting entry for that? One, we debit the specific asset account, debit the specific asset account, and then we credit this account here, which is called the business purchase account. The business purchase account. In this case, I've said we do that at the fair value of the assets which were taken over. Number two, we account for the liabilities. For the liabilities which were taken over by the new company. Remember, in this case, we have said the liabilities will be taken over by the new company. The liabilities will be taken over by the new company at their net book value. Liabilities are not revalued. So whenever the liabilities are taken over, they are always taken over at their carrying amount. So the liabilities which are taken over, we debit the business purchase account, the business purchase account, and basically we credit the liabilities account. We credit the liabilities account. We credit the liabilities what? Account. And then from there, we also account for the purchase consideration. The purchase consideration which is payable. So how much amount of the purchase consideration is our new company supposed to pay? Purchase consideration which is payable. Now, the purchase consideration which is payable by the new company that one should be debited in the account which is called the business purchase account. The business purchase account, and then we credit an account which is called the selling company. The selling company is like a creditor. So this company should pay the selling company a certain amount of purchase consideration. A certain amount of purchase consideration. Then, after making these 3 journal entries, we must prepare this particular account here, the business purchase account, basically to determine whether the business of the old company, or basically to determine whether this company acquired the assets, the liabilities, and the business operation of the old company at a goodwill, or basically a negative what? Goodwill. So not negative goodwill, we don't have negative goodwill. So at goodwill, or something called a capital reserve, a capital reserve. And actually we prepare that account, or we determine a goodwill, or basically the capital reserve, using using these 3 accounting entries. So mean that to prepare the business purchase account, after now making these 3 accounting entries, so let's look on how we prepare that account, the business purchase account. Business purchase account. So from this accounting entry number 1, we are saying that this particular account should be credited with the asset which were taken over. So the asset taken over at their fair value, they should be credited in that account. They should be credited in that account. And then here the liabilities which were taken over, in that account they should be debited. So we debit this account with the liabilities which were taken over. The liabilities which were taken over. And then this purchase consideration, you can see that account is still supposed to be debited. So the purchase consideration. The purchase what? Consideration. So those are basically the 3 items which you record in this account. And then from there, we balance this account. And I hope you can see, if you can be able to recall what you did in FR, that topic of converting partnership into a company, there is no much difference here. There is no much difference. So the balancing figure on this side is always the goodwill. Any balancing figure on this side is basically a capital reserve. Is a capital reserve, of which this goodwill, this one will be recognized as an asset in the statements of financial position of the new company. This one is an asset, and then a capital reserve, this one is recognized as a component of equity. As a component of what? Equity is a component of equity. So therefore, this basically how we account for the external reconstruction, merger, or basically what? Absorption. So first of all, we have to make a set of accounting entries to cross off the books of account of the old company or the selling company, then make another set of accounting entries to open the books of account of the new company or the purchasing company. Now, what makes this particular question to be a little bit complex? The reason why these questions are a little bit complex, unlike those questions of converting partnership business into a limited liability company, in these particular questions, the examiner will not give you the purchase consideration. The purchase consideration, this one is not given. So that is the amount of money which is supposed to be paid by the new or purchasing company after acquiring the business asset and liabilities of the old company. So the computation of this usually makes these particular questions to take a lot of time and also to be a little bit complex. But maybe during our revision, I'll be able to you'll be able to see that whenever you come across such a question, like last sitting there was this question, whenever you come across this particular question in an exam setup, we usually advise the student, never bother yourself computing the purchase consideration. So if you do this particular question without computing the purchase consideration, it should not take you even more than 30 minutes. You'll be able to do that during a revision, and you will be able to get more than 15 marks. But if you decide to compute this purchase consideration, this basically can make you to do this particular question even by taking more than 1 hour. Now, in this case, there are basically 3 methods which are used in the computation of purchase consideration. 3 methods, but all the questions which have been tested, they require the use of one method. So the first method is called lump sum method. So at the lump sum method here, the purchase consideration to be paid by the new or purchasing company is agreed as a certain amount, So no need of computation here. It is agreed at a certain amount. Then we have the other method, net asset method. Net asset method here we take, to compute the purchase consideration, we take the asset which are taken over, at their fair value minus the liabilities which are taken over. So that difference between the fair value of the assets taken over and the liabilities taken over, it basically represents the purchase consideration to be paid. The other one, and basically which is applied in all questions which have been tested in the past, is the net payment method. So under the net payment method here, we compute the purchase consideration by adding the payments which are made to the shareholders of the old company, and also the other financiers. Who are the other financiers? The other financiers include the debenture holders. So here we add the payment made to the shareholders, and other financiers, of the old company. So once the new company acquired the business asset and liabilities of the old company, the shareholders of that old company, the other financials like debentures holders, will be paid. In this case, they are usually paid by the new company in terms of being issued with the shares and maybe debentures free of charge. Like in this case, we'll be told that company X here was liquidated, its assets and liabilities taken over by a new company, maybe called company Y. So in this case, you'll be told that this company made a payment to the shareholders of this company, and that payment was in form of shares. The shareholders of this company were issued with the shares. They were issued with the debentures. The examiner will not have given you the specific shares, the specific debentures which were issued. Is upon you to compute. And basically, the computation of that I'm saying here usually take a lot of time. You compute the value of the number of shares, the value of the debentures which were issued. By the end of the day, you add the value of the shares issued to the ordinary shareholders, the value of the shares issued to the preference shareholders, the value of the shares and maybe debentures issued to the debenture holders of this company. You combine all that. So whatever you get by the end of the day is the purchase consideration. So if you check on all the questions now which have been tested, they require now you compute the purchase consideration using this method, the net payment method. Method. So basically that is it. That's what you need to know as far as this is concerned. And actually, this is an area which was examined last sitting. So meaning that the chances of this being repeated again is very slim. Very, very slim. So in fact, we will start with that question which was there last sitting. That is a question we will start with. The question for April of 2025. And basically this was the question number what? This was the question number 4. Usually these questions for external reconstruction, these are questions always for 20 marks. For 20 marks, they are questions carrying 20 marks. So that is the question number 4. Question number 4. So therefore, what I want us to do, I want us to just take a small breather, a breather of 5 minutes, or we can just take a breather of 7 minutes. We come back at exactly 5. And basically make sure you have this question with you as we come back. So let's take that small breather of 7 minutes, and then we come back exactly at 5, so that we start this question here. So see you after that short break. Yes, so the question reads, 𝐎𝐍𝐋𝐿 Limited, a private company, has been experiencing dwindling sales in the recent years, largely due to stiff competition. The company directors, who are also the main shareholders, would like to transfer the assets and liabilities of 𝐎𝐍𝐋𝐿 Limited to a newly formed company, 𝐵𝐵𝐿 Limited, with effect from 1st of April 2025. The following is the latest statement of financial position of 𝐎𝐍𝐿 Limited as at 31st of March 2025. We have assets there, equity and liabilities down there. We then have additional information number 1 all the way to note number 8. What are we required to do here? We are required to prepare the following ledger account, close off the books of account of 𝐎𝐍𝐿 Limited, realization account, the preference shareholders salary members account, the ordinary shareholders salary members account. Part B, we are required to make the journal entries in the books of 𝐵𝐵𝐿 Limited to record the acquisition of 𝐎𝐍𝐿 Limited. No narration not required. And then part C, we are required to prepare the opening statement of financial position. So this question basically was a very simple one. This basically a question once you come across this question, then you should be assured that you have 15 marks with you. So basically, from the information we have in the first paragraph, we are told the company, which is called 𝐎𝐍𝐿 Limited, is a private company. This company has been experiencing dwindling sales. The sales have been reducing due to competition. The directors of this company in paragraph 2, who are also the main shareholders, want to transfer the assets and liabilities of this company to a new company, which is called what? 𝐵𝐵𝐿. So meaning that this company, which is called 𝐎𝐍𝐿 Limited, basically this is the old or what? The selling company, which basically will be liquidated and then transfer its assets and liabilities to a new company to be known as 𝐵𝐵𝐿 Limited. 𝐵𝐵𝐿 Limited, therefore, is the new, in other terms, the purchasing what? The purchasing company. That is the first thing which you need to understand from that particular word question. Now, we have said, how do we account for this? Because this is basically an external reconstruction. This is an external reconstruction. How do we account for this? We have to close off the books of account of 𝐎𝐍𝐿, and basically that is what is required in part A. We prepare the books, or we close off the books of account of 𝐎𝐍𝐿, and then in part B, we are required to make the journal entries to open the books of account of the new company 𝐵𝐵𝐿, and then from there, we prepare the statement of financial position of the new company, which is called what? 𝐵𝐵𝐿. I've said these questions are very simple. The only challenge with this particular question is the computation of purchase consideration. That is what only give you headache. But if, for example, you are doing this question in an exam, we advise you not to compute the purchase what? Consideration. But because this basically we want to understand how we do this one, we have to compute the purchase consideration, and then maybe during our revision, I'll be able to show you the shortcut of doing these particular questions without necessarily computing the purchase consideration. So therefore, the first thing I want us to compute here, because that is the only item which we compute in these particular questions, is the purchase consideration. This purchase consideration, I've said, is computed using the net payment method. The net payment method. So recall we have said under the net payment method, we add the payment which were made to the shareholders of this company and the other financials, including debenture holders. That payment is in form of shares. That payment may be in form of debenture. We add the payment which was made to them. So therefore, for us to be able to do that, what we do, we go to the balance sheet of this company. Can we go to the balance sheet of this company, specifically at the equity? The main objective here is to know the shareholders of this company. Was this company having the ordinary shareholders and the preference shareholders? And then we go to where we have non-current liabilities. We see who are the other financials of 𝐎𝐍𝐿 Limited. Can we go to, first of all, to equity? So if we go to the equity section, you'll be able to see this company had issued ordinary shares. The company also had issued preference shares. Then, what about the non-current liabilities? Do we have non-current liabilities? No, no, no. In fact, therefore, this question, therefore, is very, very simple. So what we need to do here, and I hope you can see our figures are given in thousands of shillings. So we will determine the payment which was made to the two categories of shareholders. We determine the payment to ordinary shareholders. Which payments were made to the ordinary shareholders? And also we determine the payment to the preference shareholders. So when this company, when the assets and liabilities of 𝐎𝐲 Limited were taken over by 𝐉𝐎𝐈𝐍 Limited, so which payments were made to the ordinary shareholders and the preference shareholders of this company by the new company? Now, that information about the payment is always given in the addition information. Can we go to the addition information number 1? Let's go to the addition information number 1. We need to move together here. So in note number 1, you are told the authorized share capital of 𝐉𝐴𝐍 Limited, that is the new company, comprised of 100 million shillings, 100 million, comprising of ordinary shares of shillings 10 per value. So that is all about the authorized share capital of the new company. Then note number 2, we are told 𝐉𝐴𝐍 Limited. Remember, 𝐉𝐴𝐍 is the new company. 𝐉𝐴𝐍 is the one which is to pay the shareholders, the ordinary shareholders and the preference shareholders of 𝐉𝐴𝐍. So we are told in number 2, 𝐉𝐴𝐍 Limited issued new ordinary shares in favor of the preference shareholders in 𝐿𝐴𝐍 Limited on the basis of 3 new ordinary shares for every 5 preference shares which were held. And then let's move to the other sentence. We are told the ordinary shares were credited at 6 bob. I will be able to explain what you mean by that. And the preference shareholders in 𝐿𝐴𝐍 Limited were to pay up the balance immediately to make their shares fully paid. So in that case, what you are given here, in that point number 2, are the ordinary shares which were issued by the new company. The ordinary shares issued by the new company to who? To the preference shareholders. To the preference shareholders of this company. So meaning that is a payment which was made by 𝐉𝐴𝐍 Limited to the preference shareholders. So we will come here and basically we determine the number of ordinary shares, or actually we will come here and we determine, don't write that first of all. We will come here and we determine how many ordinary shares were issued to the preference shareholders of 𝐿𝐴𝐍 Limited by this company. So that is something we have to compute. Let's go back to point number 2. We are told 𝐉𝐴𝐍 Limited issued new ordinary shares in favor of the preference shareholders of 𝐿𝐴𝐍 on the basis of 3. On the basis of 3, this is basically how we put it. On the basis of 3 new shares for every 5. Are we together? For every 5 preference shares which were held. It basically means that this company was to issue 3 ordinary shares for every 5 preference shares which were held. So for us to be able to determine the ordinary shares which were issued by the new company, we need to multiply this with the number of preference shares, with the number of preference shares which were held in which company? In this company here. In this company. So first of all, can we determine this? The preference shares issued by 𝐿𝐴𝐍. So where do we get that? We go to the balance sheet of 𝐿𝐴𝐍, specifically at the equity, and I hope you can see the preference shares. They have a value of what? 45. How do we get the number of shares? We're going to divide that with what? To get the number of preference shares issued by 𝐿𝐴𝐍 Limited. We will take 45,000, we divide that with what? We divide that with what? We divide that with the par value. We divide that with what? The par value. Is that the case? Is that the case? Please give your answers here. Give your answer in the chat box. This one will be divided with what? We want to know the preference shares issued by 𝐿𝐴𝐍. We have taken its preference share capital. We divide that with what? With the 10. So meaning that the preference shares issued by 𝐿𝐴𝐍 were 4,500. So therefore, we are told the new company, 𝐉𝐴𝐍, was to issue 3 ordinary shares for every 5 preference shares which were held. So we need to multiply that with 4,500. So this will give us the ordinary shares which were issued by the new company, you can use a wrong approach of doing it. So because we are told the new company was to issue 3 ordinary shares for every 5 preference shares which were held. This is a wrong approach of doing it. For every 5 preference shares which were held. And then we know that the preference shares which were held were 45. You cross multiply, then you divide. 3 times 45 divided by 5. You can see by the end of the day is the same with what we have here, but I'm saying this is a wrong approach of doing it. A wrong approach of doing it. So just work with this. So here, we will get what? I'm told this will give us 27. 27. Is that what you're getting? This is saying what? This is saying, sorry, Morima, the question is not calling it share capital. It's not calling it share capital. Which one? What are you referring to? This. Okay, so let's take that point again. You need to understand the point first of all. So we are told 𝐕𝐎𝐈 Limited, which is the new company, issued new ordinary shares in favor of the preference shareholders of shareholders in 𝐒𝐎𝐋𝐈𝐍 Limited. 𝐒𝐎𝐋𝐈𝐍 Limited. In other terms, the new company, which is 𝐕𝐎𝐈, was to issue ordinary shares to who? To the preference shareholders. That's basically what you're told. On the basis of what? On the basis of 3 new ordinary shares for every 5 preference shares which were held. So you just need to understand that the new company was to issue 3 ordinary shares for every 5 preference shares which were held. For every 5 preference shares which were held. In this case, we are saying, for you to be able to determine the ordinary shares issued by our new company, you must determine how many preference shares had been issued by the old company. That's why we are taking the preference share capital of 𝐒𝐎𝐋𝐈𝐍, dividing that with the 10 to get the number of preference shares which were held. Are we together? You must understand that risk. Sasa? Yes. So therefore, no, automatically 45,000, these are not shares. Risk. Are these shares? These are not shares. These are not shares. This is basically share capital. This is share capital. For you to know the shares, you divide that with the par value. That's why we are dividing that with the par value. 45,000 here, they are not shares. Whatever is recorded in the balance sheet are the share capital, not the shares. We record the value of the shares, not the shares. Understand? Yes. So this one will give us what? This one will give us 27. Is that the case? Is that the position? Is that the position? Yes, because that will give us that. So meaning that here we say that the preference shareholders were issued with 2,700 ordinary shares. And in that case, there is another point which are given very, very important in the last paragraph of note 2. We are told the ordinary shares were credited at 6, and the preference shareholders in 𝐒𝐎𝐋𝐈𝐍 Limited agreed to pay up the balance to make up the shares fully paid. It basically means that these preference shareholders were issued with shares. Why are they issued with the shares by the new company? They issued with the shares by the new company as a form of payment. But now the agreement is that the new company is not issuing the shares, is not issuing these particular shares as fully paid. So we are told they are credited at 6. So meaning that these shares which were issued to the preference shareholders, they are issued for free to an extent of 6 bob. To an extent of 6 bob. If you can be able to remember in note number 1, what is the par value of the shares of the new company? The shares of the new company, which is 𝐕𝐎𝐈, they have a par value of what? The ordinary shares, as per note number 1. They have a par value of what? They have a par value of 10. Can you see that in note 1? They have a par value of 10. So, but now, when the preference shareholders were issued with these shares, the shares were not issued to them 100% free. 100% free. They were issued, those shares were issued to them for free to an extent of 6 bob. They are not required to pay 6 bob. That is a payment made to them, but automatically they will have to pay the balance. The balance will be what? The balance they will have to pay to the new company will be 10 shillings minus 6. They will have to pay the new company 4 shillings per share. But now this amount to be paid, this basically we will account for it in the books of account of the new company. So this is an amount to be paid to the new company. So that one will be accounted for when opening the books of account of the new company. So what we're interested with here is the value of the shares which were issued free. So the value for the shares which were issued free will be the shares which were issued times the amount they were not required to pay per share. This is basically the payment which was made to them. So this will give us what? This will give us 16,200. 16,200. So the shares which were issued to them free of charge as a form of payment had a value of 16,200. Had a value of 16,200. Is that understood? Before we move to something else, is that understood? Is that understood? Yes or no? Is that understood? Is that understood? Yes. So let's then move to the other note. Note number 3. We are told the preference dividend in 𝐿𝐎𝐂𝐔𝐒 Limited were 2 years in arrears, and the new company issued 540,000 fully paid ordinary shares of shillings 10 each as a final settlement of the arrears. So the first thing we need to compute here are the preference dividends in arrears, because we are told this company here had not paid dividends for 2 years. The preference dividends in what? In arrears. So how do we compute the preference dividend in arrears? We get the information from the balance sheet of 𝐿𝐎𝐂𝐔𝐒, specifically under equity. So the preference shares issued by 𝐿𝐎𝐂𝐔𝐒 were 12%. 12% means that this company in each financial year should pay dividends equal to 12% of the preference share capital. The preference share capital is 45,000. So this is the preference dividend to be paid annually, but we are told these dividends were in arrears for 2 years. So we multiply this with 2. We multiply that with 2. So that will give us what? That will give us what? This will give us what? This will give us, are you getting that amount there? Is that what you're getting? Yes, yes. So that now will give us an amount of 10,800. So these are the preference dividends in what? In arrears. The preference dividends in arrears. Now we are told, remember this basically an amount of money which was owed to the preference shareholders. They were supposed to be paid this amount because their company has been purchased. They were supposed to be paid this amount. But now in note number 3, we are told the preference dividend in 𝐿𝐿𝐒𝐂𝐔𝐒 Limited were 2 years in arrears, and the new company issued 540,000 fully paid ordinary shares of shillings 10 each as a final settlement. So in that case, what we need to do is basically to determine how much amount was paid to the preference shareholders as a result of these preference dividends which were in arrears. In this case, we are told the preference shareholders still here, they were issued with 540. Remember, we are working with our figures in thousands of shillings. So those shares, we take them as 540. We omit the last 3 zeros. They were issued with 540 ordinary shares, and basically those shares we are told they were issued as fully paid. As fully what? Paid. So that's why now we are using the value of 10 shillings. They were fully paid. So and basically this will give us what? This will give us 540. So it basically means that out of this amount, the preference shareholders were just paid 540. They were paid 5.4 million. Out of 10.8 million, they were just paid what? They were just paid 5.4. It basically means that the difference will be a loss covered by them. The difference will be a loss which was covered by them. So what we account for here is basically the payment. The payment. They were paid and they were paid an amount of 5.4. It was not paid to them in cash. They were issued with the shares free of charge as a form of what? A payment. So if that is well understood, I want us to move now to point number 3. In point number 3, we are told that Tobbins Limited, which is basically the new company, issued a new ordinary shares in favor of the ordinary shareholders in 𝐿𝐎𝐂𝐔𝐒 Limited on the basis of 2 new ordinary shares for every 5 ordinary shares which were held. In that case, those are the ordinary shares which were issued by our new company to who? To the ordinary shareholders. So in this case, we need to determine how many ordinary shares were issued to the ordinary shareholders. Very simple, because we are told, we can take that point again, we are told, 𝐻𝐻𝐶 Limited issued new ordinary shares in favor of the ordinary shareholders of 𝐂𝐻𝐿 on the basis of 2 new shares for every 5 shares. That's how you put it. 2 shares for every 5 shares which were held. In this case, just like what you have done down here, we need to multiply this with the number of ordinary shares which were held in this company. The number of ordinary shares held in 𝐂𝐻𝐿. How do we determine that? We go to the equity section of the balance sheet of 𝐂𝐻𝐿, and we take the ordinary share capital, which is 80,000. We divide that with the par value per share, which is 10. That will give us the ordinary shares issued by who? The ordinary shares issued by this company. And because the new company was to issue 2 shares for every 5 shares were held, we multiply that with this. And we determine the number of ordinary shares which were issued by the new company to the ordinary shareholders. I've said if you can't be able to understand this approach which Morimo is using, you can use the wrong one, this one. You can use this is the wrong approach. The wrong approach means, or we are told using this the wrong approach, which by the end of the day will take us back here. We are told the new company was to issue 2 ordinary shares on the basis of 5 ordinary shares which were held. In our case, we know the ordinary shares which were held were 8,000. You cross multiply, then you divide. It will take us back to this 2 times 8,000 divided by 5. The same with this. So avoid this. This is the wrong approach. Use this one. So this will give us what? This will give us 32. Then we need to know how are these shares issued. Were they fully paid? Or maybe the shares were issued for free to a certain extent. So we are told in the same point, the other sentence, these ordinary shares were credited at 4 shillings, and the ordinary shareholders in 𝐂𝐻𝐿 Limited committed to pay the balance to make their shares fully paid. So the shares which were issued to the ordinary shareholders were 32 ordinary shares, and in this case, we are told the shares were issued for free to an extent of 4 bob. So they will have to pay the new company the balance of 6 shillings, which basically we have said is an accounting entry in the books of account of the new company. So this will give us what? We take the shares times this. And that will give us what? That will give us 1280. Now, I'm saying this question was very simple because these are the 3 items you just needed to compute. We don't have any other payment which was made, just those 3. But now, in this case, there is also something else we come and we add here, the liquidation cost. Remember, in this case, we have said that this company will be liquidated. Mostly the liquidation cost, which is incurred by this company, is paid by the new company. Once it is paid by the new company, that will be part of the purchase consideration. That information is usually given in the last 3 points. So you'll be able to see this in all questions for external reconstruction. Like if you go to the last 3 points, point number 6, 7, and 8, you must be given information about that. So, and that information is note number 7. The liquidation expenses of 𝐂𝐻𝐿 Limited, that one, amounted to 12.8 and were paid by Tobins. That is always the information will come across in all questions for external reconstruction. So that liquidation cost, it is also considered as part of this because it was paid by the new company. So then what we need to do is basically we add all this, we get the purchase consideration. Give me the total here because I want us to do at least part A, even if we will not be able to finish. But we can be able to finish. I feel that we can be able to finish because that is basically the only part which was a little bit tricky. So give me that total there. give me the total, and then we move now to the other part. So I'm told the purchase consideration here is 47,200. 47,200. 47,200. Now, having that, then what we need to do, can we go to part A? So this is the only requirement which is required. I want us now we move to part A of that question. What are we required to do? We are required to prepare the foreign ledger account to close off the books of foreign's. Ledger accounts, accounts to close off the books of who? Of 𝐎𝐻𝐂𝐔𝐒 Limited, of 𝐎𝐻𝐂𝐔𝐒 Limited. So, and in that case, you can see the ledger account you're required to prepare. There, the first one is the realization account. The realization account. The realization account. Realization account. Then we need to have the other account, which is the ordinary shareholders. Ordinary shareholders. Sundry members account. Sundry members account. Okay, that is the basically think Roman 3. Roman 4, that is Roman 2. We are required to prepare the preference shareholders, sundry members account, sundry members account. There is also another account we are going to prepare, though it's not part of the requirement there. Though it is not part of the requirement. And basically that is an account called purchasing company account. Purchasing company. The purchasing company is this one. Which is Tobins. Tobins Limited. Tobins Limited account. Tobins Limited account. So let's prepare this account together. I hope you already have that format with you. Yes. So let's prepare this account. Basically, I'll see to prepare these accounts, or in other terms, to close off the books of account of the old or the